A very good morning, friends. So I hope you made your cumulative revision, just like a cumulative catch-up adjustment, what we discussed yesterday. So we were studying Ind AS 115, and we've covered so far out of the five-step model. I have covered the initial two steps with you. Now, today the focus is going to be on step number three, and there are a lot of things what we need to discuss on step number three. But I think before I take the journey forward with you, I am just thinking just to let you know that, what are the various sub-steps we have created. I'm not going to revise anything what we have covered so far. The idea is only to just, take a recap because since it is a step-by-step model, I just want to keep a track that, your mind is working on how many sub-steps you did in terms of step one or any kind of special issue which we covered in terms of step number one. So I think let me just take a quick recap on things regarding only the number of steps we have covered in step number one or in step number two or in the special issues related to any of these steps. And then we're going to start a journey in terms of step number three. So when I started off with this particular standard with you, we of course identified that this standard is based on a five-step model. And the first step what we covered with you was regarding identifying the contract. So it was basically looking at whether it is a valid contract or not. And in this particular case, when we decided that it is a valid contract, I gave you a simple three-step model. Caution again, friends, this three-step model is not a part of the standard, but I gave you for the ease of understanding. And I created in this particular case a simple three-step model. So within the step number one, I created a three-step model to you. And in terms of this three-step model, the focus was on the five conditions. The focus was on the advance. And then the focus was in terms of treating the advance as a revenue or treating the advance as a liability. So basically, the three-step model which I elaborated out here was focusing on three areas. Number one, it was focusing on the five conditions which are given in para number 9. And then it was focusing whether we received an advance from the customer or not. And then deciding that do we treat this advance as a revenue if the three or the two set of conditions are met, or we are going to treat this as a liability and keep making a reassessment. That was a focus when we did the step number one. I'm just trying to revive your knowledge early in the morning because it gets embedded well into the mind. Then after I finished with the step number one, I took you to certain special issues in this case. I said that there are certain special issues which we need to discuss in terms of step number one. And I discussed a total of two special issues with you with reference to the step number one. One of the special issues which we discussed was the concept of combination of contract. And I also gave you a flavor in terms of the portfolio approach under the standard versus the concept of combination of contract. The concept of combination of contract is supposed to be mandatory in nature. And we decided that when you're looking at the concept of combination of contract, the focus was that it is certainly mandatory in nature, but I made an emphasis that there are two parameters which will trigger the application of. There are two parameters which would trigger the application of combination of contract. And I said that you need to first of all see that the contract is entered at or near the same time, and it is entered with the same customer or a related party. So once the two parameters are triggered, then the para number 17 becomes mandatory in nature. And in terms of combination, we decided you need to meet one out of the three conditions. There were a total of three conditions in terms of para 17, and we decided that you need to meet any one of the three. Now, this is very important that the mind is very crystal clear in terms of, how many conditions are there. Do you need to meet all the conditions? Do you need to meet any one of the conditions? So you need to be very careful on those thoughts. This standard actually contains a lot of these inputs. And I think if you're able to remember them, then I think it's going to be very easy to solve a question in the exam. Then after this, I came to the second special issue, and that is the concept of modification of contracts. That if the two parties mutually agree to make a change in the price or the scope of both of the contract, then it results in a modification of a contract. And in terms of the modification of the contract as well, I created out here again a three-step model. This is again not a part of the standard, but for the ease of convenience, again, I introduced you to a three-step model where the focus number one was identifying the goods are distinct or not. So here again, we had a three-step model. And first of all, the focus was deciding that is it distinct or not distinct in nature. The moment it is not distinct in nature, you go to the step number three. And in this particular case, we apply the cumulative catch-up adjustment. We call it as a CCA, a cumulative catch-up adjustment. You can also call it as a CCUA, whatever. And the moment we say, yes, it is distinct in nature, then there are two kinds of treatments available. Either you treat it as a separate contract where you got two conditions. When you treat this as a separate contract, there are two conditions. Otherwise, we consider it to be a termination and it is considered as a prospective accounting. A cumulative catch-up adjustment, I reminded you, was a case of a special kind of accounting which involves a retrospective computation and a prospective accounting, and that's what we call the cumulative catch-up adjustment. Then, after the concept of modification was done, I came back to the area and we started discussing the area on step number two. We came to the main step number two. And when I came to the step number two, it was identifying the performance obligation. And once we decided that we are identifying the performance obligations, in that particular case, we've got a two-step model which I created for you. One is looking at from the entity's point of view and looking at whether the entity is selling these products independently, regularly, on a separate basis or not. And then the step number B, focusing from the customer's point of view, where we looked into the para number 29. And we said, if there are three conditions and any one of them is getting met, it's a failure of the step number B. So we created, and this is again, I created for the ease of convenience, a two-step model. This two-step model is again not exactly a part of the standard, but I created a simple two-step model in this particular case where we focused from the entity's perspective and we focused from the customer's perspective, and we wanted to evaluate whether every promise is going to be considered as a distinct promise and therefore it becomes a performance obligation or not. And then as far as the customer's perspective is concerned, I've again given you three aspects which were given in terms of para number 29, where the words were very clear that it either involves a significant integration, or it involves a significant modification, or it is supposed to be highly interdependent and interrelated. Then in those particular cases, the customer's perspective would fail, and we would say that all the promises are going to be clubbed as a single performance obligation. So that's what we've covered in the journey so far. I thought it's worth, giving you a quick recap on things, because a lot of things what we discussed in the last 2 days, and of course there are a lot of things now we're going to discuss in the coming class today, and then the further two classes as well. So this has been the journey on this particular standard, and I hope you've been doing a cumulative revision. I just added a little inputs to your cumulative revision early in the morning. I hope that helps. So before we start, let me just see if there is any questions coming on your side. A very good morning to all of you once again, friends. And I think Namrata has got a question. A contract approved each party's right identifiable terms of the payment. Okay, that was the 5 conditions you mentioned, not a question. That's great. And then you said the scope and all, wonderful. Okay, I think that was great. I think making a quick revision along with what I just mentioned. Great, super. So now let me start the journey, friends, in terms of step number 3. Now you must be wondering that I am going to make a statement that whether things are going to be a little technical today or not. Yes, they are going to be less technical as compared to yesterday. But then, yes, they will be slightly technical compared to the day one. So we can say not as technical as day two, but yes, slightly more technical as day one. And there is some interesting question which awaits you today. If you ask me the journey in terms of Ind AS 115 from the examination point of view, I distinctly remember that there are a total of two wonderful questions which have come in the exam so far. One of the questions came in November 2020, and that was on step number 3, which is on the determination of a transaction price. So it was on one of the aspects on step number 3. It was a wonderful question which came in November 2020, if I rightly remember. And this particular question came for 14 marks in the exam. I am carrying the suggested also because I would like to save a little time as I do that question, because that question can take a lot of time to do. But trust me, it's a wonderful question, a treat in terms of step number 3. Another exam which took place in January 21. And this question in January 21 was also on step number 3, one of the aspects on step number 3, which came for 12 marks in the exam. So November 20, that was one, and January 21. Okay, sorry, not December, I said. Yes, November 2020 and January 21, two consecutive attempts saw two beautiful questions on Ind AS 115. 40 marks in November 20, followed by 12 marks in January 21. I think these are the two brilliant kind of questions which are there. So I think today my agenda is, of course, step 3. I'm not saying that we're going to wind up step number 3 today, but because there are a lot of issues related to step 3. So today the focus, of course, is going to be on step 3. Now, let me start the journey with reference to the step number 3 video. Now, hear me very carefully, friends. We are now focusing on the main step number 3, and the main step number 3 is to determine the transaction price. It is to determine what we call TP, that is the transaction price. So let us first of all evaluate what is a transaction price, and let us see the connected issues as far as a transaction price is concerned. Now hear me very carefully, friends, because slowly and steadily we're going to pick up a technical inputs to you. When you look at a determination of a transaction price, the transaction price basically means the consideration. If you ask me what is a transaction price, it is basically a consideration which is paid or which is payable. Mind the words carefully. It is a consideration which is paid or payable by the customer to the reporting entity. So we're looking at the consideration which is paid or which is payable by the customer to the reporting entity. Now, apparently, it doesn't seem to be any kind of a challenge that what's the big deal in terms of a transaction price. You can pick up a contract and you can easily identify that this is the transaction price. But I would say there are a total of 5 issues. I would say there are a total of 5 issues which we need to consider in the calculation of the transaction price. Now, what are those 5 issues? Don't worry, I'll document them. One is very simple, that the consideration is fixed in nature. The customer and the entity decided a fixed consideration which is payable to the reporting entity. So there are no challenges in terms of fixed consideration, but one of the challenges which we need to consider is when a customer buys a product from the entity would also charge a GST. So the question rises that let's say if you sell a product at 100 and it is 18% GST is added, so the price becomes 118. So what do we consider the transaction price to be? Is it including or is it excluding GST? The answer is simple, it is excluding GST. Because GST is not an amount which the entity will get. It's a collection on behalf of a third party. You're collecting this money on behalf of the government and is going to be deposited back to the government. So that's not my revenue. So when you're considering the consideration, one thing is very clear, that you don't need to consider the amount of GST as a part of the revenue. So if I sell a product of 100 plus an 18% GST at 118, my revenue is supposed to be 100 excluding the GST. So that's the only thing we need to keep in mind when the consideration is fixed. Second, there could be an element of a variable consideration. Now, this is crucial, and we're going to spend time, first of all, understanding the variable consideration. We'll see what are the issues. So, but let me just make a list of the 5 issues, as I said. So when you're looking at a transaction price, we are going to be concerned with a total of 5 issues. So we're going to make a discussion on these 5 issues one by one. The first issue is that the consideration is fixed. And I've already made a mention that when the consideration is fixed, you need to consider the amount of consideration excluding GST, because GST is a collection on behalf of a third party. The second agenda, what we need to discuss in detail, is a variable consideration. Now, let me explain a bit about variable consideration, then we'll do the extensive discussion. The question rises, what is a variable consideration? Now, I would say the variable consideration can be of 2 types. Now, this is crucial, friends. Hear me very carefully. I would say the variable consideration is of 2 types. One is, for example, my customer tells me that, okay, there is a fixed consideration of 10 lakhs, which I'll pay you for the completion of the project. And he tells me that if you complete the project on a timely basis, I'm going to give you some extra incentive. I'm going to give you some extra bonus, which means the receipt of that bonus is dependent upon whether I complete the project on time or not. So the fixed consideration of 10 lakh is something which is going to be received by me once the project gets completed, or maybe on a staggered basis. But the amount which is going to be dependent upon the early completion of the project is something which is contingent, is something which depends upon the early completion, which I don't know at the moment whether I will be able to complete the project on time or not. So this is one thing, which we need to consider as a variable consideration. That means it could increase the amount of TP. The focus is the bonus which I'm going to get is going to increase the amount of TP. Let's take another contrasting example. Let's say, for example, I told the customer that, okay, if you buy initial 10,000 units from me, I'm going to sell the product at 100 rupees a unit. If you buy 10,000 units from me, I am going to give you the product at 100 rupees per unit. But if you're going to buy more than 10,000 units, I'm going to give you a discount. Then every unit is going to be available to you at 90, including those initial 10,000 units. So you tell the customer that if you buy a certain number of units, more than 10,000, then every unit is going to cost you 90 rupees per unit, including those initial units. So the question rises that I am basically offering a discount to the customer. Now, in this particular case, be careful. When the customer bought those initial 10,000 units, he paid you 100 rupees a unit. You got something extra. Because tomorrow, if he reaches a level of, let's say, more than 10,000 units, you'll have to basically refund the money back. Or you'll have to basically adjust the consideration against the future amount he's going to pay. So which means at the very inception, you got some extra money, and this money might become refundable back to the customer. This is also a variable consideration, which means the money which is collected, received from the customer, is going to be returned back to the customer. Now, this is one thing which needs to be very clear in the mind. That when I'm looking at the concept of a variable consideration, there are 2 things which you need to keep in mind for a variable consideration. There could be something which you're going to get in the future, like, for example, a bonus. There's something which you're going to get in the future, like, for example, bonus, which will increase the amount of TP, which will increase the amount of consideration which you're going to receive ultimately from the customer. And the another kind of variable consideration is that you've already received something in excess today, and it might have to be refunded back to the customer. Like, for example, we said a discount. So we're going to see both the kind of questions where the amount of TP would increase because of a receipt of an amount at a future date. We're also going to see a question where there is a discount. So this is one thing. So this is a little inputs about the concept of a variable consideration. Traditionally, when we've been accounting things under the IGAP, that means we're talking of the accounting standard regime in that of variable consideration. Next. The third agenda is what we call significant financing component. The third agenda, what we're going to discuss, is the concept of significant financing component in the transaction price. Now, let me just give you a little flavor of what is this significant financing component. Well, many times it can happen Though don't worry, we'll be discussing each one of them in detail later, but I'm just giving you an overview of these issues which we're going to confront. Now, many times what happens that, for example, I would transfer the control of the goods to the customer, but he pays me later. So I transfer the control of the goods and service to the customer, but he pays the consideration later. And we technically call this as a deferred consideration. Now, if you allow the customer to pay later, you transfer the goods today, and in this case, he pays the money later, naturally, you're going to charge him for the interest element for the delayed payment. So that would give rise to a significant financing component. It could be the other way around as well. It could be an other way around as well, in the sense that, let's say, for example, the customer gives me an advance. And he gives me an advance, but I transfer the control of goods and services at a later date. So this is a case of advance. Naturally, if the customer is giving me advance, knowing that I would transfer the goods at a much later date, he would also like to, indirectly take interest from me. So that would also give rise to a significant financing component. So it's going to be a two-way traffic. It's going to be a two-way traffic in terms of financing component. You transfer the control of the goods today, and the consideration is received at a later date. A deferred consideration could give rise to. I'm not saying it will give rise to. I'm being very careful with the words. It could give rise to a financing component which needs to be significant in nature. And there could be a situation where you receive an advance from the customer today, but the control is transferred at a later date. So it could lead to a presence of a significant financing component. Now, at this stage, let me tell you that on this concept of variable consideration, the beautiful question which came in the exams was in November 20. And as I said, it came for 14 marks in the exam. And on the concept of significant financing component, a beautiful question came in January 21. And as I said, it came for 12 marks in the exam. So this is one of the very interesting, and I would say, a very crucial kind of a step from the examination perspective as well, because just on the concept of variable consideration, there has been a 14 marks question, and on the concept of financing component, a 12 marks question. But those questions are a blessing for all of you, because imagine when the people went for the exam for the first time and they confronted a question of this kind of a size and this kind of a marks, it's going to be challenging. But thanks that today you have these questions with you where you can broaden your mind when you're going to look at the solutions of those questions. Trust me. Then there is going to be a fourth agenda, and the fourth agenda we have discussed partially earlier as well, and that is called a non-cash consideration. Now, when I say a non-cash consideration, you would remember that earlier in the standard we were talking in terms of a barter system, a non-monetary exchange. When I said that if there is a barter system, you consider the fair value of the consideration received, because as an entity, revenue is something what you're going to receive. So when you go to consider revenue is something what you're going to receive, then we need to consider the fair value of the non-cash consideration. There are other aspects what we're going to discuss on the non-cash consideration. Lastly, the fifth agenda is with reference to consideration which is payable to customer. You heard me correct. It is a consideration which is payable to customer. So consideration is something which is receivable from a customer. Why are you saying that it is a consideration which is payable to a customer? Well, I'm saying that it is a consideration payable to the customer for the reason, sometimes we would like to incentivize the customer. We would say that you're already dealing with another company and he wants to walk out of that contract, because he's already a customer of my competitor and I want to actually bring it to me. So I would like to incentivize the customer so that I can snatch him from the competitor and bring it to me. So in this particular case, there might be a consideration which the entity, the reporting entity, pays to the customer. So how do you treat the consideration which you are going to give it to the customer? Now, this is not a discount. Let's not consider that and confuse this with a discount. Discount is going to be a concept which is a variable consideration. The consideration payable to the customer could be in terms of incentivizing the customer. It is not necessary that incentivizing would be only to take him away from the competitor. It could also be something like that. Let's say, for example, my customer is supposed to be a franchisee. So my customer is, let's say, a wholesale dealer, and he says that I can, show your product, showcase your products if you're ready to give me, you're ready to create some shelves for me, you're ready to create some space for me, you're ready to give me something. So in those particular cases, the money I'm going to spend on creating the shelves, for showcasing those particular products to the customer, becomes a part of the consideration payable to the customer. So now you can imagine that step number 5, step number 3 is such a crucial step because it has got a total of 5 agendas for discussion. Of course, the agenda number 1, fixed consideration, doesn't need much guidance because I've just given you the inputs that when you consider a fixed consideration, all you need to do is you need to consider the consideration excluding the GST, because GST is a part which is collected for a third party and it is payable to the outsiders. To the outsiders, it does not belong to the reporting entity. That was just a very opening introduction to the step number 3. I hope I am clearly understood so far on this. Let me see if there is any questions coming so far. Okay, I think nothing at this stage. Great. Right, friends. So I think we've got an image created at this particular stage, how we are going to deal with step number 3. Now, I'm going to focus first of all on the agenda number 2, that is if the consideration is variable in nature. Let's concentrate on 2. So we're going to discuss one by one. So first I'll discuss variable consideration in detail. Then I'm going to discuss the significant financing component in detail. Non-cash would not take much time. Consideration payable to customer would also not take much time. So this step is going to be heavily concentrated on the variable consideration and on the concept of financing component. Let's begin the journey with the concept of variable consideration. Okay, now give me a very patient listening because I am now about to create a very simple step-by-step model, a 5-step model which I've created on variable consideration. That's going to make life very simple. So first I'm going to explain the concept and then I'm going to take some practical illustrations with you. So let me, I think, first elaborate to you on the concept of a variable consideration. So let me first elaborate on the concept of a variable consideration. Now, what I have done for the ease of convenience, I'm putting it ease of convenience because I've created this 5-step model. It's not a part of the standard. For the ease of convenience, I have created a simple 5-step model. That's the reason, at the start, I give you an introduction that these are the steps at various places. So your focus is very clear. I would suggest, you should make some small mind maps at the end of the standard as well. It's a little pretty long standard, got a lot of inputs which you need to remember. So create your own 2-3 page mind maps at the end of the standard so you remember the crucial aspects in the standard. Now, let's have a look in terms of what are the 5 steps I am going to follow in this particular case. Now, hear this very carefully, friends. Be careful with each and every word on this. Don't worry, the notes will be coming later to you. Well, the step number 1 is you need to first of all see that is the consideration variable. The first thing which you need to see is you need to put across a question that is the consideration variable or not. Because my 5-step model is going to apply only if you are able to reach a conclusion that the consideration is variable or not. So is there any examples of list of examples in the standard, which tells us that these are variable considerations? Yes. So we will understand this in terms of step number 1. So let's do one thing. Let's, I think, teach you to the step number 1. So what I've done, I've just taken an extract of the inputs which are given on this area in the standard, and I'm just going to share you the concept of this. Okay, so this is the inputs which is given in the standard on the variable consideration, and I think let's discuss the step number 1 right away. So I'm just going to discuss the step number 1 right away at this particular stage. Let's see the intensity. Let me just zoom it a little further so you can see it very well. Yes, I think that's pretty much legible, I guess. Okay, now see. In the standard, we are given the inputs on a variable consideration, and it says, it gives us certain examples. It says the consideration could vary because of discounts. I'm not interested in taking you to all the examples of variable consideration, but the prominent ones is what I'm reflecting. So there could be a discount, or there could be certain incentives. So there could be discounts, there could be certain incentives, there could be certain performance bonuses, there could be certain performance bonuses or other similar item. So the few good examples which are given is a discount. A discount means which is going to reduce the consideration because the customer has bought X number of goods from you and paid you a large money. Tomorrow, when he purchases more number of units, you're going to refund him the excess money. So discount is supposed to be a variable consideration. So are you looking at a trade discount or a cash discount? Of course, I am looking at the concept of a discount, which is a bulk discount. In the sense, I give you a slab system. I give you a slab system that if you buy 0 to 10,000, the price is this. If you buy more, the price is this, which means it is dependent upon the achievement of a target later. So I'm talking of that bulk discount which you give to the customer, the incentives, the performance bonuses, etc. Okay. Now there is something very interesting as well, and the standard also makes a mention about the concept of penalties. It gives us the concept of penalty. Now there is a difference in terms of what IFRS talks on penalties and what the Ind AS talks in accounting treatment. You can say this is supposed to be a carve out. There has been a disagreement in terms of the penalty treatment, which is in IFRS and Ind AS. IFRS very clearly says that penalty is supposed to be a variable consideration always. They always consider the penalty to be a variable consideration, but under the Indian standard, there is Ind AS 115, penalty may or may not be a variable consideration. It needs to be evaluated. It needs to be evaluated whether penalty is a variable consideration or not. I'll not get into a depth in terms of how the assessment is done, but there is one very basic example which is given in the standard, which tries to elaborate the concept whether penalty is a variable consideration or not. Let's have a read. It says in some cases the penalties are specified. In such cases, the penalties are accounted as per the substance of the contract. I need to look at the substance of the contract, that what is the nature of the penalty. You know, sometimes the penalty is in the nature of a penalty. And you know, in India, sometimes the penalty is not in the nature of penalty, but it's more like, you know, telling the other person, boss, I'll kill you. You know, you sometimes try to tell the other person that out of the contract, I am the bigger party. So the penalty is not in the nature of penalty, but it is telling the other person that if you don't fulfill the contract, boss, I'm going to kill you for that. It's not exactly a penalty, but I would say it's more like, you know, telling a signal to the other person that you are too small in front of me. If you don't fulfill the contract, I'm going to kill you. So it says we need to look at the substance of the contract. Now it says where the penalty is inherent in the determination of the transaction price, it becomes a part of the variable consideration. It gives us an example that when do you consider a penalty to be a variable consideration? For example, where an entity agrees to transfer the control of goods or services in a contract at the end of 30 days. So you got a contract that you need to supply the goods to the customer by the end of 30 days, and the consideration is 1 lakh. And if you're not able to deliver in 30 days and the delivery exceeds 30 days, then you will be getting a consideration of 95,000 only. The reduction of 5,000 is regarded as a variable consideration. I think it seems logical that the customer says that if you delay my delivery, boss, it's going to be a loss for me because I have associated further commitments. So he says that if you deliver to me in 30 days time, I pay you 1 lakh. If you delay the delivery, I am going to pay you 95,000. There is a reasonable deduction. There is a reasonable deduction, mind the words, there is a reasonable deduction at the part of the customer. He says that, okay, if you delay, boss, 5,000 will be deducted. It's a reasonable deduction. Therefore, it becomes a variable consideration. It says in other cases. When I say other cases, it could be, you know, something which can be not a reasonable deduction. The customer tells me, if you don't supply me in 30 days, I'll not pay you anything. Do you think this is in the nature of a penalty? No, it's not in the nature of penalty. In this particular case, I would say this is giving a dhamki to the other person, telling the other person on the contract that, this is the case. Now, you would say, so why in India, did we actually create this kind of a concept? Well, all I can say that internationally things a little different, and in India things a little different. You could enter into an agreement and contract and dictate your own terms, and if the other person is willing to sign the contract, I mean, that's how the contracts are made in India. So I even consulted a lawyer in this particular case when we confronted a practical scenario, and I asked him, how do you decide in terms of the standard that penalty is a variable consideration or not? He said, sir, I'll tell you one thing, that sometimes in India, the consideration, even the courts in India are sometimes deciding that the penalty is something reasonable or unreasonable nature. So all I can say as a conclusion, that under the Indian standard, if the penalty is something which is reasonable in nature, then it is a variable consideration. But if it becomes unreasonable in nature, then it is not a variable consideration. Now, don't ask me what is the dividing line in terms of reasonable and unreasonableness. I don't think so. I can really give you any cutoff factor that what is reasonable or not. In this example, they're trying to give you that there has been a 5% deduction for delayed delivery, which seems to be quite reasonable in nature. Now, what is unreasonable, I can't say. It only says in other cases, the consideration transaction price will be considered as fixed. So I'll not consider the penalty as a variable consideration, but the penalty, if paid any, would be treated as a separate transaction altogether. It's not a part of the variable consideration. So I think let's get one thing very straight. The first thing what you need to do in every question is, first of all, zero down on the fact that whether the consideration is variable or not. So the simple examples are discount, incentives, performance bonuses, penalties, if they are reasonable, right? So let me just come back. So this is the first step which I gave you, that you need to first of all decide that is the consideration variable or not. Oh my God, what happened? So we need to decide in this particular case, we need to decide that is the consideration variable or not. Just a second, I think the file simply got a little disturbed. We're just loading the file back. So in this particular case, I need to basically decide in this particular case that my steps go, oh, we are safe, we are safe. That's the benefit of technology as well, that you don't lose out on things as well. I thought this is going to be a penalty. I'm talking in terms of penalty, and my board is telling me, boss, I'm going to penalize you. It was a reasonable penalty. So therefore, a variable consideration indeed. Okay, so the inputs which I need to give you at this particular stage is that is the consideration variable. So we can give you examples of considerations being variable in nature. The example is, like, for example, we said discount, a case of a bulk discount dependent upon the quantity purchased from the entity. It could be incentive, it could be a bonus. And I think let me make a mention that penalty if reasonable. Penalty if reasonable. So if there is a reasonable penalty, then I'll say yes, it is indirectly representing a variable consideration. So your step number one focus is going to be very clear. When you go to read a question, please identify that is the consideration variable or not. Okay. Now the answer is either a yes or the answer is either a no. Well, if the answer is a no, then this concept is not applicable. It's not a variable consideration. Because if you say it's not a variable consideration, then my 5-step model would not apply. It's the end. We stop at that stage. Now, if you say yes, we need to go to the step number 2. So once you decide that yes, it is a variable consideration, we need to go to step number 2. Now, understand the step number 2 very carefully. It's a very crucial step for understanding. So hear me very carefully, because the language could be slightly disturbing. Now, in terms of step number 2, the standard requires an assessment. In step number 2, the standard requires an assessment. What kind of assessment? You need to make an assessment that do you think the customer will be able to avail the discount? Do you think he'll reach the slab where he will be able to get the discount or not? Do you think that as an entity, you will be able to receive the bonus or not? You need to basically evaluate that if you're looking at a variable consideration, do you think as an entity, I will receive the bonus? Will I be able to complete things on time? You need to make an assessment that today the customer bought 10,000 units at the rate of 100. Will he reach the second slab or not according to my past experience? Do you think he will be able to avail a discount or not? So in second step, we need to basically make an assessment. We need to make an assessment, and there is some typical words. There are some typical words which are given in the standard, and I'd like to take you to those typical words that what have we used the terminology as far as assessment is concerned. Let me just take you out here. So if I just come back to the concept of the terminology which has been used out here, let me just have a look out here. Okay, I think I've not put that. I'll not put that. So I think let me just, directly share the inputs to you. I'll tell you the language, which is being used in the standard is beautiful indeed. I'm just quoting, unquoting what the standard says in terms of the step number 2. That what does they say in terms of assessment? Now mind the words carefully. I'll elaborate those words. It says it is highly probable. It says it is highly probable. The words used are highly probable. Let's circle the words. It says it is highly probable that significant reversal. The word used is significant reversal. So let's circle the word significant reversal. It is highly probable that significant reversal of the amount. Significant reversal of the amount. Significant reversal of the amount recognized as revenue. Recognized as revenue will not take place. So it says will not take place. Circle the word will not take place. Now let me explain what is the assessment talking about. A very beautiful sentence. I think the language, the wording which is used in this assessment is brilliant in nature. It says it is highly probable that significant reversal of the amount recognized is not going to take place. Let's take a simple example, 2 examples to understand what does this assessment imply. I think let me just add on another page and explain this to you. So let's take an example number 1. I am sitting at the contract inception. I am sitting at the contract inception and my customer tells me, I'm sitting at the contract inception and my customer tells me that I will give you a fixed consideration 5 lakhs and I will give you a bonus of another 1 lakh rupees if you complete things on time. He's incentivizing me in the form of bonus. So one thing is very clear that the bonus is undoubtedly a variable consideration. So at the contract inception, he says, this is the fixed consideration and this 1 lakh is the variable consideration, which you get if you complete things on time. Now, I sit down at the year end on the balance sheet date. I sit down at the year end on the balance sheet date and I now need to make an assessment. Though this assessment is required at the inception also, but you need to do the assessment typically on the balance sheet date when it comes to the recognition of revenue. So I am now going to ask myself, if I consider the transaction price to be 6 lakh, let's say, I am confident that yes, I will get this bonus. I'll complete things on time. So I say, okay, the transaction price is going to be 6 lakh rupees. And if I'm using a percentage of completion method, PUCM, if I'm using a percentage of completion method and I say, let's say 30% work is done, I land up recognizing revenue to the extent of 1.8 lakhs. So I would say this is the transaction price. And according to the percentage completion method, 30% work is done. Let me recognize a 30% revenue, that is 1.8 lakhs. Now, the standard says it should not happen later. It should not happen later that you say, oh, It was a mistake of considering that 1 lakh rupees as a part of the transaction price. Technically, I should have taken 5 lakh rupees only, and with a 30% degree of completion, I should have taken a revenue of 1.5. It was a mistake. So it says, what does it say? Let's go back to the language and see what it says. It is highly probable that significant reversal of the revenue should not take place. It should not happen that you land up recognizing a revenue today and tomorrow you say, no, 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 there is a need to reverse. I'll tell you one thing. I'll tell you one thing. Why does it talk of that? Hear this again carefully. If you land up recognizing a revenue of 1.8 lakhs and later your reassessment tells me that you should not have taken this as a part of the variable consideration, you have recorded extra revenue of 30,000. The difference between 1.8 and 1.5, you've taken that extra revenue of 30,000. There is a need to reverse this revenue in the year when the reassessment took place, something like a cumulative catch-up adjustment. You'll go back and do the retrospective computations and say, I should have recognized a revenue of 1.5, but I took a revenue of 1.8. So the company will land up reversing 30,000 revenue in the year in which this particular reassessment takes place. And you realize that it was a mistake of considering this as a part of the TP. So they are cautioning the company that, boss, if you're going to consider a variable consideration as a part of the TP and you land up recognizing revenue, be very sure it should be highly probable that a significant reversal. Now you would say, sir, is 30,000 significant? Judgment, friends. Let me change the figures in crores. I think from 1.5 crores revenue to 1.8 crores, you're recognizing an extra revenue of 0.3 crores could be huge in nature. So what is important is that if you say that, yes, let me add the variable consideration to the transaction price, you land up recognizing revenue. Tomorrow, you should not say, I am sorry. In simple words, I should not say that I'm sorry. It should not result in a significant reversal. Okay, there is a possibility that you took a revenue of 18,000 today and you realize, though I should have taken 15,000, I understand that a reversal of 3,000 is not significant in nature. So the key terms which have been used very carefully is there is a high probability. High probability does not mean 50%. It has to be much, much more than 50. Standard does not define what high probability means. But they use the word high probable. When I use the word probable, it itself means 50% plus. So when I say high probability, I would say there should be a very high percentage of probability, but there is no cut-off factor of the percentage. So it says it is highly probable that significant reversal should not take place. You need to be sure that if you land up considering a variable consideration as a part of TP and you land up recognizing revenue, I repeat, if you land up saying that the variable consideration is a part of the TP and you land up recognizing a revenue on that, you should not say at a later date, oh, it was a mistake. You would not land up reversing the revenue. So if you today recognize a revenue because you've taken the variable consideration as a part of TP, you should not say that it was a mistake and you land up reversing the recognition which has taken place earlier. So the company needs to be very, very clear that this is not going to happen. Okay, so this is what we call an assessment. The companies are required to do this assessment at the inceptions and at the year end both. So at the very inception, when you're determining a transaction price, so we're going to do this assessment at the inception of the contract, when you enter into the contract with the customer, and we're going to do this at every year end. So if the contract is still open at the reporting date, if the contract is still going on the reporting date, you need to do this assessment at every year end in this particular case. Be very sure that if you want to include it as a part, take some actions against the auditors in the company. But in this particular case, the standard does not address you that what kind of penalties or what kind of actions will be taken. So we are not discussing that. Okay. Now, once you make the assessment and you say, yes, but if you say no, my assessment tells me that no, I am not going to receive this variable consideration, then in that particular case, don't take it as a part of the ticket. So we'll see in a practical illustration, how do we do an assessment on these things. So in this particular case, you make an assessment, and if you say, yes, I'm sure I am going to get this bonus, let's include it in the TP. I'm saying, no, I am pretty sure I'm not going to get this bonus. Don't take it as a part of TP. The journey ends out here. Now, you go to the step number 4. If you say, sorry, you go to the step number 3. If you say, yes, it is taken as a part of the TP, the next agenda is to decide the method. The next agenda is to decide the method of taking it as a part of TP, of taking it as a part of transaction price. You need to decide a method. Now you would say, so what do you mean by deciding a method of taking it as a part of the TP? I don't know if you've done Ind AS 37, and I'm not sure whether that standard has been covered or not. Have you covered Ind AS 37, the standard on provisions? I think even if not, then I think you must have definitely done accounting standard 29 as well. Okay, Shriram, I think you tell me, so we do get stuck in the middle of an internet connectivity is very good at my end. Please ask the support team to lock it. Okay, I think they just looked into that. But generally, I think if things are going good from our end, maybe you could just try to switch on off your modem. It might work well. Okay, and I think Namrata, you had a question. So if the penalty is unreasonable, then what do we do? Then it is treated separately. It's not a part of the TP. The transaction price remains 1 lakh in that example, and the penalty will be ignored and considered as a separate transaction altogether. And you said in the second step, do we need a judgment? Yes, the second step in a practical life would involve a complete level of judgment. That's right. Manav, you said so, but as per conservatism, we should recognize that one additional lacks in the first place. No. I think recognizing additional revenue, recognizing a variable consideration as a part of revenue without assessment goes against the concept of prudence, because you land up recognizing additional revenue, which is, I would say, against the concept of prudence. Shriram, you said, sir, if in this case, at first, if the company recognizes revenue of 30% on 5 lakhs, that is 150. But after reassessment, we come to know it should be 6 lakh into this. Oh, I'll come to that. I'll come to that. Don't worry. The concept of reassessment is just about to come. You are going to get the answer. Okay, I think Vidit and I think Manav also telling me we're facing some issues on the internet connectivity. The clause, I think Jarma also tells me. Okay, we just request the technical team to just look into this if there is any kind of issue, because I think at my end, my internet is working quite well, I guess. So we just request the technical team, I think, to just look into that. Okay. And Banavi said, so that's what I said, that we should not recognize. Okay, sorry, my mistake. Then what you said is absolutely correct. Okay, let me just come back now on this particular step. Shriram, I think what you asked my friend a question, you're just going to get the answer very quick on that. Okay. So when you are considering the step number 3, you've decided that we're going to take it as a part of the TP. The next important agenda is to decide the method. You know, I'm taking a good time in order to explain these steps to you, because when you're going to go to the question of November 2020, trust me, all this understanding which I'm giving you is going to be very crucial in terms of solving the question. The people, when they went for the exams in November 2020, well, they were not very conceptually clear about the application of the standard. Because what happens most of the times, you know, that people are not practitioners, you've not done things in practical life, you really don't know, you know, how things are done. So when you know that you know how things are done in a practical life, it's more easy to understand the application of the standard, even if you get a new situation. So I think that's a good initiative, you know, that you've got practitioners coming to you and teaching you so that you get a good flavor of things. So when we see things in a practical life, you see a lot of blend in terms of your theory and the practical area. That's the good advantage. Okay, so we're looking in terms of, you know, the method you need to consider whether when it is taken as a part of TP. Trust me, the methods are the same, which are given in Ind AS 37. There are basically 2 methods which are given in Ind AS 37, equally applicable to Ind AS 115. One is called EVM. That's called an expected value method. It is called EVM. That's called an expected value method. And then there is another method as well, and that is called MLO. That's called most likely outcome. MLO, that's called most likely outcome. So these are the two methods which are given, and we need to decide, which method are we going to choose in order to measure the variable consideration as a part of the TP. So how do we decide that we're going to apply an EVM or we're going to apply a most likely outcome? Well, I would say that if you've got multiple outcomes and there is an associated probability for each outcome, if you say that there are multiple outcomes and every outcome has got an associated probability, we're going to consider an expected value method, multiply each outcome with the probability and get a weighted average. The expected value method is nothing but it's just like an weighted average method where you're going to consider the possible outcomes and the associated probabilities and take a weighted average of all the possible outcomes. Most likely outcome would generally apply when there are two outcomes. It's like you get the bonus, you don't get the bonus. It's like, sometimes you say on the lighter side, she loves me not. There are two possible outcomes in this case. So when there are two possible outcomes, you need to look at the better percentage, which is the most likely outcome. So if you say, I get the bonus or I don't get the bonus, I say, okay, you're going to get the bonus. There is a 70% chance. You don't get the bonus, there is a 30% chance. So there is a more likely chance that you get a bonus. So you pick up that particular outcome, which has got a higher probability. Rest we'll see in a practical illustration as well, EVM and a most likely outcome in this case. Okay, so this is the third step that you decide on the method. And then you go to the step number 4, and the step number 4 is on reassessment. The step number 4 is on the reassessment. So this is on the reassessment. Now, what is now going to give rise to reassessment is going to be super duper. Now, watch this carefully, friends. I am looking at the concept of reassessment. Let me just explain the concept of step number 4, that is reassessment. We'll do a consolidation. We'll do a consolidation as well on all the steps once again, but let's first concentrate on the reassessment, what we're talking in terms of step number 4. Now, this answers the question, I think, Shriram, which you asked me. This is going to answer your query on that. Now, let's say this is the first balance sheet date, and let's say this is the second balance sheet date. In step number 2, you did an assessment on the first balance sheet date. When it was a variable consideration, in step number 2, you did an assessment on the first balance sheet date. Now, when you did an assessment, when you made an assessment, what are the various possibilities? The possibility is that you decided that it should not be taken as a part of the TP, and accordingly you took your revenue. Or you decided that it will be taken as the part of the TP, and accordingly you took the revenue. So there are only two possibilities which took place. That you decided that yes, it is not to be taken as a part of the TP, or you decided yes, it is taken as a part of the TP. Now, on the second balance sheet date, what can happen? There can be two sub possibilities further. You decided that it's not a part of the TP, you still decided, yes, it should not be a part of the TP. Then there is no change in the assessment. The TP doesn't change. So in this case, the TP does not change. If the TP does not change, do you think I'll have to make any rectifications on a cumulative catch-up adjustments? No. Because you took a transaction price saying variable consideration not a part of TP, even on the reassessment. On the second balance sheet date, what you're doing a reassessment at this particular stage. Your analysis tells you that it should not be a part of the TP, so the TP doesn't change. The revenue recognition which was done was absolutely correct, so it leads to no further accounting. It leads to no further accounting in the sense I don't need to rectify any accountings which are done in the past. I don't need to go back and decide that I have taken some additional revenue by mistake or I have taken some lesser revenue by mistake. I don't need to change the revenue which I've already recognized in the past. That is one. Now, let's have a look at the other one. You decided on a reassessment, yes, it should be a part of the TP. Now, when you say yes, it is a part of the TP, can I say the TP changes in this particular case? If your reassessment tells you that the transaction price is not the same, you have taken a different revenue in the past, but you should have taken a different revenue now. And here I am going to go to the step number 5, where in step number 5, let me tell you in advance, I am going to do a cumulative catch-up adjustment. I'm going to do a cumulative catch-up adjustments. I'm going to see what revenue I had taken earlier, what revenue I should have taken now, and the difference is going to be taken in the year in which this TP changes. Got it? Okay, then let's consider other combinations. You took it as a part of the TP and now you decided, no, it's just not a part of TP. The TP again changes. The transaction price again changes, and you again go to the step number 5, and you need to do a cumulative catch-up adjustments. How do you do that? Don't worry, I'm going to take a walkthrough on a very interesting question where the TP is going to undergo a change, and we're going to see how things are accounted for. Now, in the last combination, you said it's a part of the TP, and you say, yes, it is a part of the TP. Does the TP change? You'll say the TP doesn't change, but it can change. You heard me correct, it can change. When you consider it as a part of the TP, imagine you said we'll get a bonus of 3 lakh, there is a 50% chance. You get a bonus of 4 lakh, there is a 50% chance. So you decided that this is going to be 3.5 lakhs as a part of the TP. Later on the reassessment, you said you're going to get a bonus. This has now got, let's say, an 80% chance, and you're going to get a bonus of 4 lakh, that is a 20% chance. So 2.4 plus 0.8, that becomes 3.2 lakh, which means due to the change in probability, getting my point, due to the change in the probability, the calculation of the amount taken as a part of the TP undergoes a change. So we can say TP can change. I'm not saying that it will always change, but it can change. There's a possibility that the probabilities remain the same, the TP doesn't change. But if the probability undergoes a change, then the TP could undergo a change. Then again, I'll have to go to the step number 5. I think you would have got your answer, I think, on that. So let me now consolidate the entire picture. Theoretically, I have given you the insight on the 5-step model. Let's consolidate. Then we're going to apply this in a practical question with you. Let me just consolidate. I'm sure there are some questions coming in. Let me just, I think, first come to your questions before I go further. And Manu said, okay, that was earlier. Okay, I hope, friends, so far so good. Are we clearly understood the concept? If we do a consolidation, then I think we'll see if there are any further questions coming to your mind. So let me just, first of all, consolidate the learnings out here. Very interesting, and it can be very, very challenging at the same time. So we are focusing on one of the components of transaction price. There are 5 elements of transaction price, and we're focusing on the first element of transaction price, and that is called a variable consideration. So I'm giving you a 5-step model in terms of a variable consideration, that when you solve a question on a variable consideration, keep the parameters in mind, that the first step you need to evaluate is that is the consideration variable or not. Now, I gave you a few examples of the consideration being variable. I said the consideration is variable if you're talking in terms of a discount, if you're talking in terms of any performance bonus, any kind of incentives, or even if you're talking of penalties, provided the penalty is reasonable in relation to the contract. Now, what is reasonable, unreasonable is a matter of judgment, so we're not getting into all that. So once you zero down in the question, yes, it is a variable consideration, then comes the judgmental task, which is an assessment. And what kind of assessment do you need to consider? It has to be highly probable that a significant reversal of the amount of revenue does not take place. If your assessment tells you, yes, the variable consideration is a part of the TP, and you land up recognizing revenue, you should not later say that, okay, sorry, it was a mistake. It should not have been taken as a part of the TP. I have taken excess revenue. It could be the other way around also, that you never took it as a part of the TP, so you landed up taking revenue accordingly. Reassessment tells me, yes, I am going to get this amount. So there should not be much difference in terms of your assessment and reassessment. Your judgment has to be such that it doesn't lead to a huge difference in terms of things. You should not land up saying earlier, no, it was not a part of TP, and then suddenly you say after a few months, yes, yes, it is a part of TP. The reason why the standard setters have actually given this particular clause is companies could manipulate the revenue recognition. If let's say, for example, my IPO is about to come and I want to basically enhance my turnovers and the profits in the company, I will land up saying for all the variable considerations that I am pretty sure that these amounts will be received. And I know from inside that I'll not receive these amounts. And then at a later year, I make a reassessment and say, boss, it was a mistake. I should not have taken that amount. So it's going to be a very easy escape route for the companies. They would land up recognizing more revenues in the initial years by variable consideration being taken as a part of TP, and then just simply say that the assessment was wrong. So we want the companies that they need to be very careful on the assessment. You need to be pretty much sure. There can be a change in the revenue, but there should not be a massive change in the revenue. Your assessment needs to be very accurate indeed. That's what the burden they put on the companies and on the auditors, that they need to be very careful on the assessment part, that if you're planning to take it as a part of the TP, be very sure that the reversal is not going to take place. You don't have to go in the future and change the amount of revenues which you've taken in the past, because this change in revenue is not going to be recorded in the previous year. It's a cumulative adjustment, so which means you calculate from a retrospective effect, but you're going to take the impact in the future year, in the year in which the assessment changes. Once you say, yes, it is a part of TP or not, if you say, yes, it is a part of the TP, you decide a method. So there are two methods available. One is expected value method, where you've given possible outcomes with associated probabilities. And the other method is a most likely outcome. Generally, there are two outcomes. You get the bonus, you don't get the bonus. See which has got a higher probability. And once you've done that, then at every balance sheet date, you will make a reassessment. And this reassessment we will discuss in detail, which could trigger the cumulative catch-up adjustment in this case. It could trigger the cumulative catch-up adjustments. And I'll explain this in terms of the step number 4. That when you made an assessment, you landed up saying it's not a part of TP or a part of TP. When you make a reassessment, there are 4 permutation combinations which can arise. You stick to the fact that yes, it's still not to be taken, then no further adjustments. I don't need to go to the step number 5. Because earlier also you said it's not going to be received. Now also you're saying it's not going to be received. But if you say now the reassessment tells me that it should be taken as a part of TP, you need to do a cumulative adjustment. And here also, if you took it earlier and now you say not to be taken, then again TP changes, then cumulative catch-up adjustment. If you say it is taken and still taken, TP can change. So we'll have to see the permutation combinations, that if the reassessment leads to changes in the TP, we'll have to rework. In the cumulative adjustments, we'll have to rework the revenue which you had already recorded in the books of accounts, vis-a-vis what should have been recorded, and you're going to take the change, increase or decrease whatever in the year in which the transaction price changes. Right, friends? I hope I am conceptually very clear on our agenda so far. Let me see if there is any questions coming in. So are we pretty clear, friends, till this stage? Okay, 1 or 2 questions coming in. Man, you said, so this is why we should not allow companies to allow such variable consideration. Yes. Shriram, you said it means that reassessment, if reversal is expected to come, that reversal shall not be considered. Well, we are not saying that the reversal will not be considered. Of course, if the company makes a reassessment and there is a reversal happening, of course, from the accounting point of view, I am going to record the reversal. But, the regulatory agencies can take a different view and they could penalize the company for all these things done. As an accountant, I would, as let's say, an auditor of the company, I would do the appropriate treatment. I will do the cumulative catch-up adjustments at the same time giving a complete disclosures. But once you do that kind of treatment, it also throws upon your ethics in terms of things that if you were the auditor previously of the company and you've done something of that sort, or maybe somebody else was the auditor, then I think the agencies like NAFRA, ICI, and all, they could take MCA, they could take certain regulatory actions against the erring company, right? That is, amount accounted is already accounted and done. No further changes allowed to the terms of reversal. Yes, what you've done in the past would not trigger any changes from the accounting point of view, but your future, when you're going to reverse things in the future, the authorities could take an action against you that you've intentionally tried to manipulate things. Because if there is a significant reversal of revenue, or there is a huge amount of revenue getting recognized on a reassessment, it could trigger penalty actions by regulatory agencies, right? Okay, I hope, friends, I am pretty clear on the understanding so far. Are we pretty clear with this? Let's get your comfort zones before we go to the practical illustrations. So let me, I think, now take one simple illustration, and then I think we'll add on to a little complicated question with you. So in this particular case, okay, this one page got added. I just have to add more insight on this. Let me just add the assignment. Okay, so let me just add this. So I'm just adding now the questions to you. So I didn't get much inputs on the score levels indeed. I thought you must be pretty comfortable on the concept, I guess. Maybe, I think sometimes we get very slow answers, the net becomes a little issue, so there is a little lag. Okay, anyway, let me now come to a small little question with you on this area. First, we'll do a very basic kind of a question. Not a very basic, but a little advanced level, of course. And then I will take you to a little comprehensive question. So first, we're going to do a question. A similar type of question came in MTP in October 22. So let me just, I think, come to a simple question on step number 3, friends, with you. I guess that's going to be pretty much visible indeed. Let's have a look at this. Okay, I think we got the scores now. Yes, 7.58, and that's great. That's great. So I think that's great to watch the scores. Okay, now I'm doing a question which is a simple question to begin with before I take you to that November 20 question, which is a beautiful question indeed. Now let's go to the question number 17 and read the facts. This is one of the questions which is given in the education material on Ind AS 115. A similar kind of question came in the mock test papers in October 22. So a very interesting question. It says, B, a construction company enters into a contract on 15th April 17 to construct a commercial building for L on the land which is owned by L for a consideration of 20 lakhs. So this is undoubtedly a fixed consideration. The construction company is getting a fixed amount of 20 lakh from the customer. The expected cost of construction is 40 lakh. And as per the agreed terms, if the building is completed within 24 months, that is on 14th April 2019. So the customer tells you that if you're going to complete the construction in the next 2 years, that is 24 months, then B is entitled for a performance bonus of 4 lakh. I think needless to make a mention that 4 lakh rupees, which is a performance bonus, undoubtedly is a variable consideration because this is dependent upon completing the target deadline for 24 months. Then he says at the year ended March 18, B is satisfied 60% of the performance obligation. So we can say the degree of completion, if I'm applying a percentage completion method, is 60% for revenue recognition. And this is being calculated on the basis of cost incurred till date. And that will remind you the applications which you've done in IGAP earlier, the cost incurred till date upon the total cost expected for the contract. That's how you calculate a degree of completion. Then he says in June 2018, B and L agreed to modify. Oh my God. They agreed to modify. Does this mean that this is a case of modification and we need to apply the concept of modification para number 20, 21, A and B? Oh yes. Now, it needs to be seen that this is a case of a building construction. And in case of building construction, I think I gave you that if you request a builder that let's mutually change the scope of the contract, do you think it's going to be distinct or not distinct in nature? Give your inputs and I read the question further. Considering that it is a question on a real estate industry, a construction industry, do you think a modifications in terms of a real estate sector would be called as a situation, is going to be called as a situation where it is going to be considered distinct or not distinct in nature? We did one question, I think, yesterday on modification, and I think I made a very clear-cut mention that if you're considering a real estate sector, a construction industry, it is going to be, of course, going to be considered as a case of not distinct. That's great. Okay, that's wonderful. We got the correct answers on that. How do you get the education material? I think, Shriram, you can go to the ICA website and just type on the Google education material India's 115. You'll get it. Then it says they modified the contract by changing the floor plan of the building. Now, let me remind you that if it is a modification, then it would lead to, if it is a modification, it would lead to what? It would lead to a cumulative catch-up adjustment. Wow. As a result, the fixed consideration and the expected cost increase. The fixed consideration increases by 3 lakh and 2 lakh 40 is the cost increase. In addition, the allowable time for achieving the promised bonus of 4 lakh is got extended by 6 months. So now from 24 months, you can take a total of 30 months. So deadline for completion is 14th October. That is the original contract inception date. How should B Limited account for this contract modification? Well, apparently, if you look at the requirement of the question, it seems that they're talking about a contract modification, agreed, but at the same time, in this particular case, you see that there is going to be a change in the TP due to a variable consideration as well. Now, watch me carefully, friends. The next 10-15 minutes is very, very crucial. Either you get it or you don't get it. The chances are highly probable you will get it, but terms and conditions apply, right? So you're going to definitely get it, but terms and conditions apply. Give me a very patient listening. Watch me as I solve the solution and see this. Okay. So I think let me just come to the solution part. Let me just work it out. So let me just, I think, take the inputs, the data. Let me just organize the data first of all, and then we'll take the journey forward. So I am giving you the solution of this particular question. Well, my advice is that when you face these kind of questions in the exam, the best thing is always to make a time scale. Because a time scale will give you a complete idea of the events happening at each particular date, and accordingly, we could do the accounting treatment. So this question, I think, is already shared with you in the PDF. I think earlier, the date 1, D2 I've shared. So I'm just going to make a time scale. The question is already in front of me. So I'm just going to make a time scale on this particular basis. So let me just, I think, take the inputs again. So we are given the financial year in this case is ending on March. So let me make a time scale to begin with. So let's consider a time scale. So we are given that we entered into a contract on 15 April 17. So let's take it like this. The financial year in the question is 17-18, and the financial year in the question is 18-19. It starts from 1st April 17 and it ends on March 18. This is as good as 1st April 18, and the financial year here ends on March 19. So I'm taking 2 years in the question. Now let me just read the facts, organize the data, and then we'll decide. It says B, a construction company, enters into a contract on 15th April 17. So the date when we entered into the contract is supposed to be 15th April 17. So this is the date when we entered into a contract with the customer. So this is the inception. And very clearly, he tells you that there is a consideration of 20 lakhs. So I am given that there is a fixed consideration. There is a fixed consideration, which is to the extent of 20 lakh rupees. And then there is an expected cost as well. So there is an expected cost of construction which is also given to me, and that is 14 lakhs. I'm just noting down the data which is given in the question. And then it says, as per the agreed terms, if you complete within 24 months, you get a bonus. So I am also given that if you complete the construction in the next 2 years, you are going to get a bonus as well. And the bonus is given to us. It is to the tune of 4 lakh rupees. And undoubtedly, it is a variable consideration. We'll apply our steps the way, but let's, I think, first note the data. Then he says at the year ended March 18, which is a balance sheet date, 60% work is done. So I am now given the inputs on the degree of completion. So the degree of completion on the balance sheet date is given to me 60% based on the cost incurred. And then it says in June 18, so we are now giving the status in June 18, that is post balance sheet date. So we given in June 18, it says that the company B as well as L, the customer and the entity agree to modify the contract. So there has been a mutual change and it is a modification. And we've already seen that this modification will be considered as not distinct in nature because it is a real estate sector construction contract. So that would be considered not distinct. And the moment it is not distinct, we know it's going to trigger the concept of a cumulative catch-up adjustment as well. A CCA would apply. So it says they agreed to modify the contract, and as a result, there is increase in the consideration. So we are given that this consideration will increase. The fixed consideration due to modification. The fixed consideration due to modification increases by 3 lakhs. And there is also an increase in the expected cost of construction. And the increase in the expected cost of construction is 2.4 lakh. So modification led to the change in the fixed consideration, and it also led to the change in the expected cost of construction. In addition, the allowable time for the bonus is now 30 months. So he's also made the changes that now because of this modification, the bonus is got a deadline for 30 months. You need to complete this in 30 months time. And you're going to get the bonus if you complete within a 30 months time. And we are given, how should we account for the contract modification? I think the question would have been clearly understood by everybody. The facts are there on a time scale with you. This is the date when the contract was entered, and this is the balance sheet date, and this is the date of modification, and the events are happening in 2 different years. Your balance sheet date, the first balance sheet date is falling in 1 financial year, and the modification is falling in another financial year. Now let's begin the journey with you. So let me see if there's any concerns, any questions coming at your end. Otherwise, I'm about to start with the question. Jana, can you have shared assignment on the Board of Studies application as well? Yes, I'll have already done that. I think today also I'll share that because every time I'm sharing these notes on a daily basis on the ICI app, so you can definitely access that. Okay, so this is the inputs. Now let's begin the journey, friends, with you. Watch us carefully in terms of the solution. Let me now begin the journey and use a different color pen so that we can see things very clear. Let me use the color pen out here. Okay, so let's, I think, begin the journey and let's, I think, now evaluate. I am first of all looking at the date 15th April 17 itself. I want to first of all determine my transaction price at this date. I would say the transaction price is a fixed consideration, but the question arises that do we consider the bonus as a part of the variable consideration or not? Indirectly, I am on my step number 2. If you ask me in terms of step number 1, I would say this is like the step number 1, which I explained that is it variable in nature? Yes. Now this is where I'm working on my step number 2, that should we consider 4 lakh as a part of the TP? Now there is nothing in the question which tells me that whether this amount should be taken as a part of TP or not, but what does the logical self of judgment tells me? You know, if you complete the construction in the next 2 years, then this amount of bonus will be given to you. Isn't it too early to consider that you'll receive this bonus. I think if I'm sitting in a practical life and the client tells me that my client, my customer tells me that, I have a customer who will pay me a bonus for completion within 2 years. I'll say, boss, at this stage, it's too early to say that you're going to receive this amount. So I don't think so. I will allow you to consider this as a part of the TP. So the assessment at this stage would indicate it should not be taken as a part of the TP. Because I think the logic is simple, that it's too early that you're going to say that, yes, you're going to receive this money. It's too early to make an assessment and say that it's a part of TP. Then we finish. We finish the things at this stage. Okay, now let's go to the balance sheet date. Now let's go to the balance sheet date. And when you go to the balance sheet date, we are now making a reassessment, if you ask me. Because I did an assessment at the inception, and now on the balance sheet date, I'm going to make technically a reassessment, which indirectly means that I am applying the step number 4. We're doing a reassessment and I'm applying indirectly a step number 4. Since the assessment led to the conclusion that it's not a part of TP, I didn't go to the step number 3 and I didn't apply any methods. But when I apply the reassessment, we'll see if the method is required or not. So now we need to again calculate a transaction price. So I would say 20 lakhs certainly is a part of the TP, but what about 4 lakhs? Now, at this particular stage, if you notice how many months have really passed, I think it's almost been a period of 1 year that things have already passed by. But I feel at this particular stage, it is again a 50-50 chance. On 15th April, when you entered into the contract, it was certainly too early to consider that it is a part of the TP. But now with the progression of 1 year, one could say that yes, maybe it's a part of TP or maybe it's not. But I think in this particular case, the education material, in order to elaborate the concept, they decided that no, we are not considering this as a part of the TP. We still feel that if the company would consider this amount as a part of the TP, it would lead to significant reversal of the amounts. So though we are not given any facts in the question, which would tell me that whether the assessment is that I should take it or not, but I think logically what they decided, even on the balance sheet date, that we're not considering it as a part of the transaction price. Okay, so the reassessment again tells me that it's not a part of TP, but let me now calculate the profit or the revenue recognition. So on the balance sheet date, what I'm going to do further, I am going to calculate the amount of revenue to be recognized, and I'm also going to consider the amount of cost so that I can find out what is the profit I need to consider on this particular date. Now, considering that your transaction price is 20 lakh rupees and the degree of completion is 60%, so I would multiply the transaction price with the revenue. So 20 lakh into 60%, 12 lakhs is the revenue which is recognized on that basis. That's what you've been doing earlier. Even in terms of IGAP, you multiply the transaction price with the percentage completion. 60% work is done. Now, I am not given the status of what is the cost incurred, what is the actual cost incurred. So in the absence, I presume that the cost is getting incurred as per expectations, because I'm not given any data. So I am absolutely considering that whatever cost you're incurring is on the same lines. So you must have incurred 60% itself, because this 60% degree of completion is being calculated on the basis of cost incurred. So I believe that the company would have incurred 60% of the expected cost, and that works out at 8.4 lakh. So we get a profit of 3.6 lakh that gets recognized in the financial statements. Pretty simple, pretty straight. So all I've done so far, I have made an assessment at the inception and said that this variable consideration cannot be considered as a part of TP. Even on the balance sheet date, when I did my reassessment, I still felt that in this particular case, I am not going to consider it as a part of TP. So accordingly, the revenue recognition took place. I guess, friends, at this stage, everybody should be clear. I don't think so. There should be any questions coming to your mind so far at this stage. Okay. Now, let's take it further. Now the journey begins, the technical part of the solution. Now we come to June 18. Now we come to June 18 when a modification is done. Now, please hear me very, very carefully. I'm now looking at the journey in terms of June 18 when a modification is done. I think in order to make give the inputs in terms of how the cumulative catch-up adjustment is done, this time the solution says that now we made an reassessment. We again going to make a reassessment. Now, first of all, hear this carefully. A modification would lead to a reassessment of the variable consideration as well. Because a modification would mean a cumulative catch-up adjustment, which means you need a TP. Hear the words carefully. In June 18, when you did a modification, and we know that since this modification is not distinct and a cumulative catch-up adjustment is required, you need a TP at that stage. And this modification is leading to the reassessment of the variable consideration. I hope you get the point. It is the modification which results in a cumulative catch-up adjustment is triggering the reassessment of the variable consideration. So let's say now we make a reassessment at this stage. When I make a reassessment at this stage to calculate the TP, 20 lakhs is the fixed consideration, 3 lakhs is added because of modification. 3 lakh is the increase in the consideration due to modification, and I also need to make an assessment on the variable consideration. So this time they decided that yes, we are now getting a little more certainty that yes, I will receive the bonus. Now, I am not given any facts in the question which tells me that increase in the TP, because a reassessment of the variable consideration tells me that I am going to receive this money. So my TP in this particular case becomes 27 lakhs. Well, one could give an assessment also that I am sure that I'm not going to receive that 4 lakh rupees, in which particular case I will not consider it as a part of the TP. But in this particular case, we are considering that yes, the amount of fixed consideration increases and the amount of variable consideration is also expected to be received. So the TP becomes 27 lakh. Oh, that means I am now saying that if this 27 lakh is the TP, then the revenue recognition which has taken place earlier was not correct. Right? So what does a cumulative catch-up adjustment mean? That if this is the TP, then the revenue which you've already taken is not correct. So let's do one thing. Let us calculate what revenue you should have taken for the year ended 18. I'm doing these calculations in June 18, which is in the year 1890. Mind the words carefully. I'm doing these calculations in June 18, which is in the year 1819, but I'm saying what revenue did you take in the previous year 1718? Let's revisit. Let's do a retrospective computation and see. So let us see what revenue. Let us see what revenue should have been taken. Let us see what revenue should have been taken. So what revenue should have been taken? Let's calculate that. Now, in this particular case, when you say, let me see what revenue should have been taken, I need to multiply this 27 lakhs with the degree of completion. In order to calculate the amount of revenue which I should have taken, I need to multiply this with the degree of completion. So I want to calculate the degree of completion now. Now, very careful on the degree of completion. What is the cost I have incurred till date? I have incurred 8.4 lakh rupees of cost till date. And what is the total expected cost? Can I say it was 14 lakhs earlier and the expected cost further went up by 2.4 lakhs. So when you go to calculate the degree of completion, this is the cost incurred so far, and this is the total cost which was expected, and there is a further increase due to modification. So you calculate the percentage, that is 8.4 lakh divided by 16.4 lakh, it comes to 51.2% is the degree of completion. Now you're going to multiply this 27 lakhs with 51.2%. So if you multiply 51.2% into 27 lakh, that works out at 13.824 lakhs. This is the revenue which should have been taken for the year ended 18. So this is a retrospective computation that if I knew that this is the TP, then I should have taken a revenue accordingly. So what am I going to do at this particular stage? Compare the two. I'm going to compare the two, that this is the revenue which you have already taken in the books, but this is the revenue which you should have taken now. So you are going to book this increase in which year? This is going to be booked in the year 1819. This increase in revenue is calculated in a retrospective manner, but it is going to be accounted in a prospective manner. So this difference, that is 13 minus 12, 1.824 lakhs, is going to be recorded in the financial year 1819 as a part of the revenue of 1819 itself. That's what the solution is. Beautiful indeed. So I think, let me just give you a quick recap in terms of things. So what we have done, basically, we've done the solution in 3 phases, if you see. The phase number 1 is that when you entered into the contract and at the inception, you made an assessment whether the variable consideration will be taken as a part of TP. We said no. Then on the balance sheet date, which is a phase number 2, we made an assessment and we again said a no, that it should not be taken as a part of TP. So accordingly, the profits and the revenue recognition took place. But then there was a modification, and this modification is triggering 2 things simultaneously, if you ask me. The modification is triggering the application of para number 21B. The modification is triggering the application of reassessment of the variable consideration, which I think is para number 56 or 59, I don't remember. So this is triggering 2 things simultaneously. When you did a modification, you need to make a reassessment of the variable consideration because of the modification. And this time we took the change in the fixed consideration, and the reassessment says, yes, we are now sure that we'll get this money. And on that basis, we said, let me calculate what revenue I should have taken. So I should have taken a revenue to the extent of 13.824 lakhs, which is based on the new degree of completion as well. You can't contain the old degree of completion because that was based on the expected cost of 14 lakhs, but the expected cost has also undergone a change. So with the amount of revenue which should have been taken for the previous year, compared to what was actually taken, you are going to get the increase which is going to be booked in the year in which modification took place, in the year in which the variable consideration, that is the TP, undergoes a change. Brilliant indeed. That was a good question indeed. I hope I am pretty much clear, friends, till this stage so far. Okay, we've got 2 questions. Mark, you said, so but as 60% is done by year 1, we can consider it probable to complete in 2 years and recognize. As I said, it is a subjective assessment. Since I am not given any facts in the question which tells me that, on the balance sheet date, it is, highly probable that a signal reversal will or will not take place. It's a matter of judgment. But I think in the education material, they wanted to give us an insight that if a variable consideration changes at a later date, how do we account for? So I think, considering the intention of the clarification was that they wanted to explain us that when a TP changes, how does a cumulative catch-up adjustment applies? But trust me, let me also tell you something very interesting. Let's say, for example, if I would have taken 24 lakhs at this stage as well, in any case, the TP would have undergone a change. But in this case, I can say this change in revenue is partly due to modification and partly due to the reassessment of variable consideration. If you would have taken that 4 lakhs out here and you would have taken the 4 lakhs out here, then I would say typically the change in the revenue would have been due to modification. But yes, due to a change in the percentage, there would have been other things as well. But as I said, it's a pure assessment, it's a pure judgment, but the facts were not given, so it's like more of an assumption, I would say. Okay, Koshki, you said, so at the time of March 18, the variable consideration should be recognized as 60%. I think you've got the similar kind of view. But as I said, the intention of the education material seems to be that they wanted to illustrate the idea of a cumulative catch-up adjustment. So I think they intentionally took the presumption that let's consider that on the balance sheet date, the assessment tells me it's not a part of TP, and then they wanted to explain that if TP changes both due to the modification and the variable consideration, so they wanted to give you an insight in terms of that there is a change in the TP, one due to modification resulting in a cumulative adjustment. Second, there is a change in TP due to change in variable consideration, which is also resulting in cumulative adjustment. Which means if somebody were to technically ask me, I would say, where does a cumulative catch-up adjustments apply? I would say till now you've learned two ways, two areas where a cumulative adjustment applies. One, if there is a modification. Two, if there is a change in the variable considerations. In both the cases, the concept of cumulative catch-up adjustment applies. You do a retrospective application of the revenue, and then you record the change in the year in which modification or the year in which the variable consideration undergoes a change, right? Okay, and Namrata, you said, could you please summarize this once again? Okay, let's do one thing. I think let's first give you a break at this stage because I have a massive question awaiting for you after the break, which is on November 2020. So just go through this particular case. I think still the concerns will give you a little snapshot further because I've repeated it just once. So just go through this. And then we're going to do a very interesting question after the break with you, which is, I just love that question. So it's almost like 8:42 friends at this stage. And I think we'll just take a 10-12 minutes break with you. So I'm going to join you after the break, friends. Enjoy your break. I'll see you shortly in 10 to 12 minutes time. Start करें. Welcome back, friends. So I hope you've taken a good rest, mental rest in the break as well. So now we have done the conceptual understanding of a variable consideration, one of the important elements of a transaction price. Now we are going to do that comprehensive question which I've been referring again and again. That is the November 20 examination question which came for 14 marks in the exam. So I think let's start the journey with you on that particular question. I have already taken that as a part of the assignment. So we will first read that question, but I'm going to share the solution as well. But that's a brilliant question indeed. Right, so this is the question number 18 out here, which is a November 20 examination question. I guess let me just slightly zoom it a little further. And let's, I think, read the question with you. So it's a brilliant question. I think if you ask me, this is one of the best questions which is there on the variable consideration part. Let's, I think, read the question with you. Let me just see if there's any questions coming to your mind as well. Shriram, so would you be giving notes after the break? Well, I've given you the steps already. So no further notes required except for that 5-step model which I give you. Now let's read the question number 18 with you. Now, in terms of the question number 18, let me just read this question with you. Now, it says ABC Limited supplies plastic buckets to wholesaler customer as per the contract entered into between ABC and the customer for the financial year 1920. It says the price per plastic bucket will decrease retrospectively as sales volume increases within the stipulated time of 1 year. Now, if you notice that in the previous question which I did with you, that was pertaining to the concept of a bonus. So that would lead to an increase in the TP. And this particular question is going to lead to a decrease in the TP because as the customer buys more units of volume, the prices is going to decrease on a retrospective basis within a stipulated time of 1 year. The price applicable for the entire sale is based on the sales volume bracket during the year. So he gives you that these are the range of volumes and this is the price per unit. So the customer buys between 0 to 10,000 units, you're charging him 90 rupees per unit for all those 10,000 units. But if the customer buys more than 10,000 units, then the prices is 80 rupees and not only for the addition units, but the price is going to be for all the units which he bought earlier as well. That means if the customer buys, let's say 12,000 units, you are going to charge him 80 rupees for all the 12,000 units. Not that it's going to be 90 for the initial 10 and it's going to be 80 for the additional 2,000. It's going to be flat change for all the units purchased. Which means you would have received an amount from the customer, which is now going to become refundable or adjustable as the case might be. Now let's have a look at the requirement of the question. All the transactions are made in cash. The first requirement of the question is suggest how the revenue is to be recognized in the books of accounts of ABC Limited as per the expected value method. So he's very clearly given you the method as well. Since the discount is a variable consideration, and if you consider it as a part of the TP, you need to decide a method. And he's already given you that we're applying an expected value method, considering a probability of 15%, 75%, and 10% for the sales volume of 9,000, 28,000, and 36,000 units respectively. So he's given you that the possible sales are at 3 levels with a different probability as well. So I think even if the method was not mentioned, I think it's clear enough that since we are given 3 possible outcomes of volume with associated probability, I think an expected value method makes definitely more sense. Then he says for workings, assume that ABC achieved the same number of units of sale to the customer during the year as initially estimated under the expected value method. So even the actual sales turned out to be exactly what we expected. So this is the first requirement of the question, that we need to show how you are going to recognize a revenue in the books of accounts if I am considering an EVM method for the purposes of the measurement of a variable consideration. Then next, it says in case ABC decides to measure the revenue based on a most likely method, that is MLO, instead of expected value method, how would the revenue recognized in the books of accounts be of ABC will be based on the above information? Very interesting. The examiner is testing your knowledge on both the levels, that if you follow an MLO or if you follow an EVM, then how would the revenue recognition undergo a change? Then he says for workings, assume that ABC Limited achieved the same number of units that was estimated under the most likely method. So everything happened the way we expected. So this method is on, the first requirement is on an EVM. The second is on a most likely outcome. We need to reflect a revenue recognition. How would we record the same? Then he says you're also required to pass journal entries in the books of the company ABC if you are using an expected value method. He did not ask you the journal entries in terms of a most likely method. He's only asking you journal entries related to the expected value method. So there are a total of 3 requirements in the question. The focus number 1 is that if you apply an expected value method, then what? If you apply a most likely outcome, then what? And then he's asking you the journal entries as well. Now, to me, I think the answer which was given in the suggested has been very beautifully given, because they've tried to incorporate all the permutation combination. So I think I'm just going to save a little time. Instead of writing the entire answer, I'm going to give you an explanation. I'm going to do the analysis of the solution, and then I'll summarize the solution to you, so we save a little time, because time is definitely a key factor. So let me do one thing. I have the suggested answer with me, and I think let me just share the suggested answer to you, where we're going to make the analysis of this question. Let me just insert that out here only. So let me do one thing. Let me just add a page out here. Let me just add the suggested answer. Just give me a second. I'll just add the November 20 suggested. So let's have a look out here. So this is the suggested answer, and we're looking at the solution given in the suggested answer. Let me just locate the question. Yes, it was question number 2E, and this is the answer. Now let's begin the journey. I'm just going to do the analysis of the solution with you, and I'm going to summarize the inputs to you. So this solution is going to take slightly a little more time, but trust me, your conceptual clarity at the end of it is going to be pretty much well. Okay, so let's begin the journey, and let's start this with you. Okay, now watch me carefully on this analysis. So we are now first of all working on the very first requirement of the question. And the very first requirement is that we're looking at how the revenue is going to be recognized if the company is following an expected value method. Now, before I read the solution to you, I think let me first of all give you some insight. You know, in this particular case, when you're deciding the revenue recognition, we need to understand one thing very clear, because I'm telling you this thing because this standard is new to most of you. There might be a few of you who might have done the standard earlier, and I think we need to understand the transition change which has taken place as per the earlier IGAAP accounting and Ind AS 115. You know, the earlier approach was always that if you receive an X amount on a cash sale, I'm talking about cash sale, I'm not looking at a credit sale. If you receive an X amount from a customer on account of cash sale, that itself becomes a revenue. Now that is technically incorrect. You are not supposed to recognize a revenue according to what you receive. So that means when you put an entry for a revenue recognition, that is cash gets a debit and a sales revenue gets a credit, you need to understand that the amount which you record on the debit side of the entry is the amount received. The cash in the journal entry gets a debit on account of the money you get from the customer. but the sales revenue is not necessarily equal to the cash received. So in the requirement number one, what he's trying to ask us is that what is the amount of revenue you are going to recognize? So on this basis, we need to decide a revenue recognition policy for the company. That if the company knows that they are allowing a discount to the customer, which is a variable consideration, then how would I incorporate this discount at the time of measurement of revenue? So for this purpose, we are given three possible outcomes that the expected sales volumes are these three. And we're given an associated probability. So we can take a weighted average and identify that what is the expected volume of sale. But revenue recognition requires not only the volume assessment, but it also requires a price assessment. So the question rises, how would I get a price assessment? Now, you know that for a given three volumes of sale, there are three different prices applicable and three different probabilities applicable. So you also get a weighted average price. Trust me, under the expected value method, when you considering a volume expectation, you are considering weighted average. When you're considering a price per unit, you're again considering a weighted average, because expected value method is nothing but it is an application of a weighted average method. So the first working note which we are going to prepare in order to calculate the revenue recognition is the volume expected and the price on the basis of which revenue will be recognized. So let's have a look. So this is the working note number one, and this is the working note number two. The first one is working on a volume, and the second one is working on, you can say, the price, the weighted average price per unit. The idea is to get the expected volume achievement. The idea is to get the expected weighted average price per unit. So what we have done, we are clearly given these three volumes in the question, and we are given three expected probabilities. We multiply this and get a weighted average. So this is nothing but it is a weighted average volume. Makes logical sense. The company is expecting these volumes of sale, and these are the associated probability. You just multiply the volume with the expected probability and you get a weighted average. So the company is expecting a volume of 25,950. Now, go to the next exercise, and what we've done, we've taken these units and we've taken the prices on the range which is given in the question. Like if you look at 9,000 units, you can see in the question it falls in the first bracket, 0 to 10,000. If you look at 28,000, it falls in the second bracket. So we've taken the prices from the range which is given in the question, and there is an associated probability which will give you a weighted average sales value, which gives you a weighted average sales value. You divide the weighted average sales value by the weighted average units, you are going to get the weighted average price per unit. You're going to get a weighted average price per unit. Now, the common mistake which the people did in the exam is when they were looking at an expected value method, they made a common mistake. Many students calculated this weighted average 25,950, and then they went back to the question. And then they went back to the question and they said, okay, 25,950 is supposed to be the expected volume. And after considering that this is the is weighted average. So that was one common mistake which many students did. They said that since in the question we are given these three volumes and we are given the three associated probability, just get a weighted average. And just look at that weighted average 25,950, that it lies in this range and it becomes 80. No. So you need to be cautious on one part. The volume is on a weighted average calculation. The price is also on a weighted average calculation. Okay, now coming further to the input now, once you've calculated that this is the weighted average price, which means every time a company makes a sale, you receive a certain amount, but the revenue to be taken is 79.13. Let me elaborate this to you. Now, if I just come back to this particular chart, this 25,950 has to be divided into two slabs. We can say that when the customer purchased initial 10,000 units, He must have paid you 90 rupees per year. And when the customer bought those additional 15,950 units, that is when he goes to the next slab and he buys that additional 15,950 units, then he pays you 80 rupees per unit. So when you sold him 10,000 units, he paid you 90, but I will take a revenue 79.13. When you sold in 15,950 units, you are going to receive 80, but I'm going to take a revenue 79.13. So then what do you do with the difference? The difference becomes a deferred revenue for me because I cannot take that revenue in my books of accounts unless and until the year end takes place. Let's have a look further on this. So once you've created this revenue recognition policy, before I go to the concept of the most likely outcome, let me take you to a little walkthrough on the journal entry for the expected value method itself. So I'm taking a little jump and I'm taking you to the third requirement of the question to give you a clarity. I'll come to the most likely outcome later, but I just want to have a look now, right now, only on the EVM method. Now see what is the entries, the journal entries which the company is going to record in the books of accounts based on an expected value method. When the company made the initial sale of 10,000 units, the entry done is bank gets a debit at the rate of 10,000 units into 90. The cash gets a debit to the extent of the amount collected from the customer, but the revenue recognition is not on the basis of 90, but the weighted average 79.13. So when the revenue is given a credit, it is recorded at 10,000 into 79.13. The excess money collected cannot be recognized as revenue. Does this mean that we are making a calculation that my assessment tells me according to an expected value method, I can only consider this amount as a revenue today? Yes. The excess which you collected from the customer might have to be refunded back to the customer. So either you could create what we call a contract liability, or you create an account, what we call a deferred revenue. You can interchangeably use the two accounts. So this liability can either be called as a contract liability, or this can be called as a deferred revenue in this particular case. So we'll put that excess money, the difference between 90 and 79.13, this excess is taken in the deferred revenue, or it is taken as a contract liability. Now, how this contract liability will get knocked off by the end of the year, we'll see. We have done the entry based on the initial sale of 10,000 units. I'm not saying that the customer would have bought entire 10,000 units in a one go. He might have purchased the units 2,000, 2,500, but the real idea to tell you is that this is the entry which will be done till 10,000 units are sold to the customer. Even if you sell a part of 10,000 units, you just need to remember the cash gets a debit at 90. The revenue gets a credit at 79.3 and the excess becomes a contract liability. So till the company is making a sale up to 10,000 units, the entry would appear something like this. I hope, friends, I am pretty clear till this particular stage. Okay. Now, let's, I think, take it further. So once we have understood this, let's go to the next stage. Now let's come to the next lot of sale, which is when the company sold another 15,950 units because the expected sale is to the tune of 25,950. Now, let's have a look further. Now, in this particular case, there are two things. When you sell additional 15,950, because our expected volume of sale was 25,950 units, and once the 10,000 units have been sold, there is another sale of 15,950 units. Now, there are two possibilities which can arise. And accordingly, the accounting entries could undergo a change. And in the statistic, we've given both the possibility. One of the possibility is that when the customer buys another 15,950 units, he tells you, remember that I have paid you excess money? He says, I'm going to adjust that excess money right away and pay only the difference at this stage. Or the second possibility is he pays you according to the slab of 80 rupees itself, and the company says, we'll refund you back. So there are two alternatives, two you can say situations which can arise. Situation number one, that the customer itself makes the adjustment for the excess money paid at the time of those 10,000 units. He says, I paid you the excess money, I'm going to make the adjustments right away. Or you tell the customer, don't worry, you pay me according to 80 and I'll repay the excess money at a later date. So we've shown two alternatives. You can see that there is an alternative accounting treatment which is also given. Let's, I think, look at the first alternative. This is the alternative. This is the alternative where the customer makes an adjustment. Where the customer makes an adjustment. He says that I am going to adjust the excess money which I paid you. I'm going to deduct that money. So what happens when the sale of 15,950 units are done? He says, you know what? You need to charge me 80 rupees for all the 25,950 units. He says, this is what you need to charge me. And during those 10,000 units, I paid you a total of 9 lakhs. So I pay you only the difference. He says, because now I've reached a second slab. So what is the total amount payable by me as of date? The total amount payable is 25,950 at the rate of 80. And I've paid you this amount. So he pays only the difference at the stage and adjusts all the excess on his own, which seems to be quite logical because the customer knows that he's reached a slab where now every unit is going to cost him 80 rupees. So he says, boss, this is the total amount payable Sorry, friends. I think there was a little electricity cut in between. I think the question was too technical for things to handle. So there was just a few seconds electricity cut due to which there was a trouble. I guess now everything is fine. So I'm just going to connect you back in terms of what I was discussing. Let me just take it back. I think I had loaded the suggested. Maybe I think that just went off. I'll just have to load it again. So let me just add the question once again to you. Just give me a second. I'm just going to add this. All right, so I'm back on the solution. So that was the question number 2B, which we were discussing. 2A. Right, so let me just, I think, brief it once again to you. So this part we had already discussed. That was the calculation of the weighted average price. And then we were discussing the other part on the entries as well. So this was on the entry part. Okay, then I was giving you the explanation on the alternative entries. No worry, I'll just give you a quick brief on what we're discussing. So no worries on that. Okay, let me just come back. Sorry, I think a little electricity issue. So I think everything is all well now. Okay, I hope everybody's getting things now. I didn't get a message after that, but I hope, friends, now I am perfectly audible, visible, everything is going well. Okay, so we were discussing the concept of an expected value method in this particular case. And in the concept of expected value method, we got a weighted average volume and we got a weighted average price per unit. Then I made a walkthrough in terms of the first entry with you. And in terms of the first entry, I showed you that in this particular case, when you're going to consider the sale of the existing 10,000 units, because my first slab is for 10,000 units. So I elaborated, the company is going to collect from the customer 90 rupees per unit, but the revenue will be taken on the basis of the weighted average price per unit. And whatever excess you receive from the customer, this is going to be called as a liability. So either you can call it as a contract liability, or you can park it in another nomenclature that is called a deferred income account. Now, what is going to be the treatment of this contract liability or deferred income, we're going to see later. So which means we've reached one very important input, that when you put an entry, the bank gets a credit for the money collected from the customer. The revenue gets a credit to the extent of the weighted average price identified as per the EVM, and the excess money which you receive from the customer gets parked as a contract liability. So this is what we discussed. And then I said, let's come to the balance number of units which the company sold. Now we've already seen that the total expected volume is 25,950 and the first slab is for 10,000 units. So when the company is going to sell those additional 15,950 units, there are two alternative possibilities which can happen. So one of the possibility is that the customer says, I'm going to make the adjustment of the excess money which I paid you. Or the second alternative is that in this particular case, the entity says, don't worry, we're going to give you a refund. So in the suggested answer, they've given us both the alternatives. So let's first of all look at the first alternative. This alternative is that the customer makes the adjustment. Customer adjusts the excess. The customer says that I will adjust the excess which I paid at the time of initial units, and I'm going to pay you only the difference at this stage. So the customer says that now the applicable price according to the range which you gave me is supposed to be 80 rupees per unit. So I am liable to pay in totality 25,950 into 80 rupees a unit, because this is the total sales and my total liability towards you is 80 rupees a unit, and I've already paid 9 lakh on those initial 10,000 units. So he pays the difference to you at this stage. So the bank gets a debit to the extent of the difference balance which is payable by the customer. But the revenue gets a credit. But the revenue gets a credit which is again at 79.13, and the balancing figure gets adjusted against the contract liability or the deferred revenue. I know what you're thinking now. You would say, sir, since the customer reached the second slab, ultimately the total revenue should be 25,950 into 80. Absolutely correct. But so far, the revenue recognition has been 25,950 into 79.13. So there is still a balance which is left over in the contract liability. So once the year ends, and we know that now the final figure of sales volume is known to me, now you can put that remaining balance in the deferred revenue and translate that into a revenue account. So the next entry which we will do is whatever is the balance in the deferred revenue account at this stage gets translated in the revenue. So now if you see the sum total of the revenue account in all the three entries, the sum total is definitely going to match with 25,950 into 80. I think let's have a look at this. Right now, you took a revenue on the basis of 25,950 into 79.13. So the revenue in the first two entries which has been recorded is to the tune of you can say 424 approximately. And you've just translated 22,576 as another revenue because this is the balance which is left over in the contract liability. So if you add 22,576, this comes to 20,76,000 rupees. And if you divide this by 25,950 units, you are going to get the same value, which is 80 rupees a unit. So the accounting is pretty simple and straight. So the company is recognizing a revenue on the basis of a weighted average calculation. Each time the sale is made, the company records a revenue at 79.13. The difference between the cash figure and the revenue figure gets adjusted in the contract liability account. And at the year end, whatever balance in the contract liability is left over, that gets converted into revenue at that stage. Because now I know that the volume for the given year has been fixed and the excess gets translated. I hope I am pretty clear with the three entries on EVM. We're still on EVM. I've not talked of the most likely outcome method intentionally. So I gave you how a revenue recognition would take place. How do you decide the volume? How do you decide a price? And what are the entries which are done? This was alternative one when the customer decides to adjust the excess. Now let's have a look at the other alternative, that if in this case, the company says, okay, I'll pay you the refund, then what? Let me just see if there are any questions coming in between or not. Okay, visibly clear now. Okay, that's great. Now, alternatively, in this particular case, they've also shown that if you pass one consolidated entry, how would it look like? Well, even if you don't break the entry between 10,000 units and 15,950 units, it says not an issue. In this case, what do you do? The bank is given a debit at the rate of 80, and the revenue is given a credit at 79.13, and this difference is recorded in the deferred revenue, which will get translated to revenue at the end of the year. So they have shown two set of entry. If you go on a sale of 10,000 and 15,950, or if you make a consolidated entry for the sale, it still turns out to be the same. Now, let's look at the second alternative. Now, in this second alternative, what is happening, that we will refund to the customer. We will refund the excess to the customer. The company says, don't worry, on 10,000 units. Then he pays 80 rupees according to the second slab. He doesn't make an adjustment. So the bank gets recorded with this figure and the revenue is recorded at 79.13. So whatever is the balancing figure in this entry gets adjusted in the deferred revenue or the contract liability account. And then you are now going to close that deferred revenue or the contract liability at the end of the year. And in this particular case, whatever is the balance in the liability, one portion is refunded to the customer in the form of bank. The excess money paid on 10,000 units at the rate of 10 becomes refundable, and whatever is the balancing figure gets adjusted to revenue. I know you must be thinking, so can you just document these things? in the form of a chart and tell us that what kind of permutation combinations are working? Of course, yes. So let me do one thing. I guess let me first of all summarize the inputs to you in the form of a chart out here. The question is not yet complete. We have just made a walkthrough in terms of expected value method. We're going to make a walkthrough in terms of the most likely outcome as well. Right now, the focus is EVM. Now, watch this carefully. Let us summarize the understanding which we have got on this basis. So in this particular question, what we are discussing, that is November 2020. I'm looking at the November 2020 examination questions, how the solution has been very well organized in terms of the different permutation combinations. Now, see, we are concentrating that if we apply the expected value method, the very first thing which I need to do is I need to decide number one, the volume, and I need to decide number two, the price per unit. As a part of my revenue recognition policy, if I'm looking at expected value method, we'll come to the most likely later. We'll come to the most likely outcome also later, but right now let's concentrate on the expected value method at this stage. So the first thing is that when you're deciding a revenue recognition policy for the company, you need to decide that what is the volume I expect, because the discount is a variable consideration, and in this particular case, the company has indirectly made an assessment that yes, let me tell you, step number one is the discount variable consideration. Yes. Step number two, what does the assessment say? I did not make any assessment whether I am incorporating this variable consideration or not. When the examiner tells you to apply an expected value method, he's already told you that yes, I am incorporating this as a part of the variable consideration. So I did not make any assessment. And since I am not given any subsequent balance sheet date, there is no question of reassessment. The question is pretty straight, that the examiner is already telling you that yes, the discount is a variable consideration. Please incorporate this as per the expected value method. So the moment he makes a mention that we're following an EVM, it is a clear-cut indication that yes, you need to say that variable consideration needs to be incorporated as a part of the TP. So we are indirectly deciding my transaction price in this case. We are indirectly deciding that what is going to be the transaction price. So we calculated a volume and the price on the basis of a weighted average technique. We calculated the volume on a weighted average and we said it is 25,950. We decided a price per unit on a weighted average, which was 79.13. Now, the mistake which I said, many people decided the price according to a range. They looked at 25,950 in the range and said that the price is 80. No, you need to consider the volume on a weighted average, the price also on a weighted average. So on the basis of weighted average, we got this one. Then comes the stage number two, that you're looking at the journal entries now. Now, when you're looking at the journal entries, there can be different set of entries you can give to the examiner. See how. You can tell the examiner that I can give you two set of alternative entries. Let me go stage by stage. Let me go stage by stage, or I can go in one go. Now, what do you mean by stage and one go? We are telling the examiner that, when you made a sale to the customer, there are ranges 0 to 10,000, 10,001 to 35,000. So the customer will pay a different amount at each stage. So we decided that we will split the entry for the initial 10,000 units and for the balance 15,950 units. Or we tell the examiner, I'm not going on a stage by stage. I'm going to give you the entry for 25,950 units together. I'm not going to break the entry. So you need to tell the examiner that I'm giving you all possible permutation combination entry. So I'll give you the entry based on that. If you made a sale for 10,000 units, then what? If you made a sale for 15,950 units, then what? Now see, when you give the entry to the examiner based on 10,000 units, your bank gets a debit. Your bank gets a debit to the extent of 90 rupees per unit into 10,000. Your revenue gets a credit to the extent of the policy developed, which is 79.13 into 10,000 units. And whatever is the excess that is treated as a contract liability, which is a balancing figure, or it can be put in the deferred income. This entry can be multiplied with 10,000 units. So this entry with the respective units per unit pricing can be multiplied with a total of 10,000 units. So you tell the examiner that till the stage the customer was buying 10,000 units, every time you were receiving 90 rupees per unit from him, but I was taking a revenue according to 79.13 and the excess got parked in the contract liability. Then when you come to those additional units, you tell him now the customer, now in this particular customer, there are two options. Now there are two options in this case. Now watch this case. In this particular case, now there are two options. When you look at 15,950, one is the customer says, I am going to adjust the excess. So the customer adjusts the difference. The customer makes an adjustment of the excess. And the other case is that the company refunds the excess. The company refunds the excess. So you need to tell him that, boss, I've got a huge level of clarity in my mind regarding things. That when I'm looking at the entry for the addition units, the customer says, I will adjust the excess paid, or he says, okay, you can give me a refund. So in this particular case, when the customer says, I'll adjust, the bank gets a debit to the extent of 25,950. The bank gets a debit to the extent of 25,950 at the rate of 80. He says, this is what is payable, and I've already paid you a total of 10,000 into 90, so 9 lakhs I've already paid. So he pays the difference. He pays the difference at this stage, and you give a credit to the revenue, and the revenue credit is again at 79.13 into 15,950 units. And any difference in this entry, again gets adjusted to the contract liability at this stage. So you tell the examiner that this is one alternative, that the customer in this case says that I will adjust the difference, I will pay you the difference at this stage. And lastly, after this entry, whatever is the balance in the contract liability will be given a debit and the revenue will be given a credit. At the year end, you could push the balance in the contract liability and put it in the revenue account. Then you tell him that there is another alternative. There is another alternative that this time the company says, we'll refund you the money. The bank in this particular case is the customer pays for 15,950 units at the rate of 80. He doesn't adjust any excess. He lands up paying you that now I am in the second slab. Let me pay you 80 rupees a unit itself. And you record a revenue on the credit side, which is again based at 79.13. And the difference in this particular entry again gets adjusted to the contract liability again. The difference gets adjusted against the contract liability, and then additionally another entry needs to be done. Then additionally, just like in this case, additional entry is pushing the liability balance into the revenue. Here you've got an entry which is a contract liability gets a debit with a balance available. Now you need to give a credit for the refund of money given to the customer, and you will take the balancing figure in the revenue account. The balancing figure gets a credit in the revenue. That's how the solution has been very well organized. You can see that at the first stage, you need to tell the examiner that there are two set of entries which can be given. One set of entries is, let's go stage by stage, that when I sold 10,000 units to the customer, what he paid me, what is the revenue, and what did I do with the excess. Then at the second stage, when the additional units are sold, now there are two alternatives available. One is that the customer says, I will adjust the difference, or the entity says, don't worry, I give you the refund. So you tell him that this is the entry for the revenue, and then the balance in the liability goes to revenue. This is the entry for the revenue, and then the refund and the balance goes in the revenue. Beautiful. Excellent permutation combination. Then we are also giving the entry to the examiner that if you go in a one go, this is all if you go stage by stage. Now, if you go in one particular go, then in this case, the entry is bank gets a debit. Bank gets a debit, which is 25,950 because we are going with one go at the rate of 80. Because now we are in the second slab, so we say consolidate entry, that's bank debit. The revenue gets a credit to the extent of 25,950 at 79.13. And whatever is the balancing figure that enters the contract liability in this case. Now you would say, sir, I would give this early entry and I don't want to give anything else to the examiner. Well, my friends, the question is for 14 marks. And I think if it is a 14 marks, you need to, the expectation of the examiner is also that you're going to give him a good, clean answer, giving a great understanding of your thoughts. So it is very important in this particular case. So you did this entry and then you tell the examiner that now whatever balance is left in the contract liability at the end will also get translated into revenue. So if you do one go entry, there are only two simple entries and the life is simple. So you need to give the examiner the two set of entries. If you go stage by stage, entry for 10,000 units, entry for addition units with the two alternatives. And if you go with one go entry, then what are the two entries? I just try to map up the entire concept in the form of this framework as well. That's the reason I made a first walkthrough of the solution. But we are still not complete with the solution, but I hope I am pretty much clear, friends, now. Right? I hope I am pretty much clear till this particular stage. The first part is done, expected value method. The third requirement is done, the journal entries. Now he's also asking you that please give me the inputs on a most likely. So before that, let's I think decide that how do you decide the volume in this case? And how do you decide a price per unit in this case? That's all I need to decide in terms of the second requirement of the question. Let's go back to the solution. So let me just go back to the solution and let's make a reference out here. So I think I loaded the suggested. So this is the solution, I guess. Yes. This is now on the second part. Let me just bring it down. So this is now on the second part. Let me just erase this. So this is on the second part of the things. Now let's read the requirement. That is the second requirement. So now we are focusing on MLO. The EVM concept is done, revenue recognition as per EVM, journal entries as per EVM. The examiner did not ask you the entries for MLO. Trust me, the entries for MLO is going to be on same lines. Because the difference is only with respect to the revenue you're going to recognize on a per unit basis. The entries which you're going to pass in terms of expected value or the entries which you're going to pass in terms of the most likely outcome is going to be same. MLO is only going to give you the insight that what is the revenue which you're going to recognize on a per unit basis. Let's read how the revenue is to be recognized. Now we're looking at how the revenue is to be recognized when you are considering a most likely MLO method. Now, in this particular case, if you look at the most likely outcome, we are given three different units. I think if you look at the number of units, just to remind you, we are given a total of 3 units. I am given that there is a total sale of 9,000 units, and this has got a probability which is 15%. Or we can say that there is a sale expected 28,000 units, and that has got a 75% probability of occurrence. And we've got a sale which is expected 36,000 units, and the probability in this case is 10%. So which has got the highest probability? When you consider a most likely outcome, you need to consider which particular option has got the highest probability of occurrence. 75% is the highest probability. So in this case, the sales volume of 28,000 units will be considered in this particular case. So 28,000 falls in which slab? It falls in the second slab, and the price per unit is 80. So when you would consider the revenue recognition, it would be taken on the basis of 80 per unit. So this is how the most likely outcome will be done, that you look at the number of units which is most likely to occur. And you also look at the range in this particular case and decide the price. So the revenue recognition in this case is going to be 80. But so we can say, if you now look at the entries, what is the amount to be taken in the deferred revenue? When you make the sale of initial 10,000 units, you're going to receive 90 from the customer, but you're going to consider 80 as the revenue, and the excess 10 rupees will become a deferred revenue. And then accordingly, the subsequent entries will follow. The only difference is that the figure in the revenue, instead of 79.13, is going to get credited at the rate of 80. Any differences in the entry will be adjusted in the contract liability or deferred revenue, which gets knocked off at the year end. They've also made a little mention as well that alternatively, the question may be solved with 25,950 units instead of taking 28,000 units. So since the company has already made a calculations of the expected volumes, so they said that instead of considering 28, you could alternatively consider 29,950. But since the journal entries were not asked, I would say that even if you finish your answer at this stage, that the volume is 28,000 and the price is 80 rupees, I think it is good enough. I hope, friends, I am absolutely clear with this. You need to definitely revise this answer once. Read it very carefully, understand what I've given you, and then try this by hand. Try the entries, pen down the answer by hand, especially the mind map which I've made you. Go through that mind map once and you get a clarity of thought. Brilliant. Let me see if there are any questions coming in between. Otherwise, we'll take it further. Right, friends? Are we absolutely clear till this stage? Let me give you inputs. Are we absolutely clear? My concept of variable consideration is done. My concept of variable consideration is done. Now, let me just quickly take a recap of things with you before we go to the next agenda, that is significant financing components with you. Right? I guess I am pretty clear, friends. Your inputs awaited. Now, let me, I think, just quickly consolidate the inputs to you, because today must have been a little heavy day as well. As I said, it's not very technical. But yes, at the same time, slightly more technical as compared to the first class. But it's very interesting at the same time as well. Okay. Now, what we understood in terms of the variable consideration, I'm just creating a quick mind map for you because I've covered two cases questions with you. So as a part of the TP, when I'm looking at the concept of a variable consideration, I have given you a total of 5-step model in this particular case. So let's take a quick look at the 5-step model. And then I'll make a quick review of the two questions I have done with you, and they're on different ends altogether. Now, in this particular case, the first one is that you need to decide that is the consideration variable or not. I did two questions with you. One is a case of a bonus, which has got the impact of increasing the transaction price. So I did one question with you that was a case of a bonus, which has got the impact that your transaction price is going to increase in the future. You may get that money at a future date. The other kind of question which I did with you is a case of a discount, which is going to result in either adjustment of the excess or the refund of the excess already given by the customer. Look at the contrast now. Look at the contrast now, that there are two kinds of questions. One is which would lead to receipt of money at a future date. Here you are saying that we might receive in future. We're looking at an assessment that you might receive an amount in the future. So you're increasing the TP and the revenue based on the assessment that you're going to get money in the future. And the case of discount is a case where you've already received. So you've already received an excess. You've already received an excess in this particular case, and that excess will either be adjusted by the customer or it would be refunded back to the customer. So see the contrasting view. Therefore, I did two questions with you. One is on a bonus and one is on a discount, because they're going to go in a reverse direction. When you look at a bonus, you're going to receive something in the future. When you look at a discount, you've already received that money, which is going to be adjusted or refunded back at a later date. Then on the step number 2, we decided that you got to make an assessment in this particular case. And assessment is, of course, judgmental in nature. Now, you're going to see a lot of questions in the study material, which you're going to try them out. And in this particular case, you're going to see that in some of the questions, nothing is mentioned, but in some of the questions, we are given. But assessment is purely judgmental. Because the standard requires you that you need to make an assessment that there is a high probability that a significant reversal should not take place. You need to be like pretty much certain in life that if you're going to take this amount as a part of TP, tomorrow you should not say that I committed a mistake. So the assessment part is quite judgmental in nature. And this judgment may or may not be stated in the question, but the facts of the case from the examination point of view will be quite clear, where you can take a call that yes, it should be taken or not. Once you say yes, it is taken as a part of the assessment, part of the TP, you need to decide on the methods. You need to decide that there are two methods on the basis of which you will consider this as a part of the TP. Either it is an expected value method, or it is supposed to be a most likely outcome. Now, if you remember, in terms of the bonus, I never made a mention on the method, but in terms of bonus, what did you apply? You technically applied a most likely outcome, because you said, I will get the bonus or I will not get the bonus. There are only two possible outcomes. And when there are two possible outcomes, we apply the most likely outcome. And when you apply the most likely outcome, you took the entire amount as a part of the TP. Remember? I took that entire 4 lakhs as a part of the transaction price, because you're saying there are two possible outcomes. You get the bonus or you don't get the bonus. I said the possibility is I will get the bonus. So you took not a weighted average, but you took the entire bonus in this case as a part of TP. But when it came to expected value method, you would take a weighted average of the amounts in the part of TP. So you need to understand one thing more, that EVM considers only a weighted average amount as a part of the TP. The most likely would consider the entire amount of variable consideration as a part of the TP. And then in step number 4, you need to go in for a reassessment. And you need to see that in this case, the TP either changes, yes, or the TP does not change. You need to make an assessment that at every reporting date, you need to make an assessment that the TP has undergone a change or not. Now, when I did the question of bonus, a reassessment was present in that question. But when I did the question of a discount, since it was one financial year, the reassessment did not take place. So you need to be careful that in certain questions, the data for reassessment may be there, and certain questions, the data for reassessment may not be there. So accordingly, if there is a reassessment data given, you need to make an evaluation and see is the transaction price undergoing a change or not. If the transaction price undergoes a change, then in that particular case, you need to do the cumulative catch-up adjustment in this case. And the cumulative catch-up adjustment is the same concept what we saw in the previous class as well. And we saw that in terms of the cumulative catch-up adjustments, you need to go back retrospectively, see what revenue you have taken versus what revenue you should have taken, and any increase or decrease taken in the past is going to get adjusted in the year in which the TP changes. It's a prospective accounting. The impact of the increase or decrease gets incorporated in the year of change, but it is done with retrospective calculation. Right. So this was a 5-step model which we've learned on the concept of available consideration. Now comes the next part. I've got a few minutes, friends, and before we meet tomorrow, I just want to put something into your mind, because this area what we're going to study on significant financing component is also a little technical area. So let me just take a few minutes, just 2 minutes, to give you some inputs. Just a few minutes, what we said earlier, just to consolidate things. Tomorrow we will of course reinforce the things back again. Now, the second area, as we said, is a case of a financing component. The second area is the concept of a financing component as a part of the TP. Now, here again, there are going to be 2 cases which we are going to study. And here again, I am going to create a step-by-step model based on the provisions which are given in the standard. Because there are a couple of things which are given on the concept of significant financing component. And in this particular case, I'm not giving the steps right now, but I will now explain what I did earlier, that there is a case 1 and there is a case number 2. The first thing which you need to watch out, that when does the concept of a significant financing component gets triggered is you need to look at the time gap. The first thing what you need to do in every question, you need to consider the time gap. What do you mean by a time gap? Case one, the control of the goods and services is given to the customer today, but the customer pays the consideration at a later date. And the time gap between this is, let's say, 1 year or plus. There is a gap of 1 year or plus. So the consideration is paid later. I tell the customer, take the goods, take the machine, pay me later. So when there is a time gap between transfer of the control and the payment, then it leads to 1 year or more, then a financing element might be present. The case number two, the consideration, the customer pays the consideration today. He says, take the advance from me. But the control of the goods and services is transferred at a later date to the customer. So he pays the money today to you as an advance, but you transfer the control at a later date. You need to look at the time gap here again and see, is the time gap supposed to be 1 year or plus? If yes, there is a possibility of a financing component. And in this particular case, we need to segregate that what is the transaction price revenue portion and the finance income or the finance charge portion. Because the financing component would become an other income or a finance charge for the company, and the revenue is going to be taken as a revenue from operation. So this is what we're going to study in detail tomorrow. And then the other two aspects are pretty simple. So we're going to carry forward the journey on step number 3 tomorrow, and then we're also going to discuss a bit on step 4. So we've got 2 more days, and I think we should be comfortably finishing the standard on Saturday with you. But then there will be a little more inputs on Appendix B. So I'll give you a little insights on certain things, but the major part of the standard would definitely get completed on Friday, on Saturday. Right, friends. So I think let me ask you if there are any questions which are coming to your mind at this stage. Any question, friends? But please do revise all what we have done today, because I know this has been technical. I think since the first class, things have been getting a little more technical. First one was easy, then it got a little more technical. Today was also technical. Tomorrow is also going to be technical, because we need to do another question which came in January 21, which is a brilliant question on the concept of significant financing component. The 4th step is not very complicated. The 5th step is not very complicated. Trust me, the complication gets over almost with the step number 3. Thereafter, the standard has not got too much complications indeed. Right, friends. So I think so far so good. I think I am not getting any further questions so far coming to me. So I think it's time to bid you goodbye, friends, on that. So thank you very much for joining. So see you tomorrow back, friends, in the morning. And please revise. Take care. Bye-bye. And thank you.